I'll share my screen. May I request all of you to please switch on your cameras? Sorry, can you make me a host, please? Okay, so let's get started where we left yesterday. And before that, if others, Ria, Samay, Varun, can you please switch on your cameras?
I have
So
one question regarding last day's lab. So, like we calculated the duration and convexity for like a vanilla bond, but is there do we apply the same formula for colloidal bonds and footable bonds also? Or
very good point. So what will happen is that the convexity, if you do it for colloidal bond, will be negative. Why it will be negative? I'll explain you. That's a very good question you asked. It's not covered in your syllabus, in your level one. I'll just give you like a broad idea what's going to happen. Okay. So one thing you should remember and understand is that in case of a callable bond, the chart will be something like this, right? What is the slope of the line throughout? It's not positive slope. This is also a negative slope. It's all negative slope throughout. But what is happening is, यहाँ पे it's flat, यहाँ पे the slope is increasing, again यहाँ पे it's flat. So if I draw a line here, on the right side of the line, from being steeper, it's becoming flatter. So that's the reason we call it convex. But on the left side, from being steeper, it's becoming flatter. Or if I look at from this point, it was flatter, but it's becoming steeper. So flatter becoming steeper is concave, but steeper becoming flatter is convex. But throughout the chart, the slope is negative. So as a result, duration will always be negative. But the convexity on this side, it's a positive convexity, but on the left side, it's a negative convexity. This is using the graphical manner, you can draw these conclusions. But if I want to do it a bit more mathematically, let's assume that the face value is 100, the coupon rate is 10%, the market rate is also 10%. As a result, the market value is 100. Remember, it's a callable bond. What will happen in case of a callable bond? If the market rate becomes 11%, the value will go down similar to any other bond. It'll become, let's say, 95 rupees. But when the market rates go down to 9%, will the value go up to 105, 106? No. The increase is very, very minute. Let's assume the increase will be 102. Okay? So in this case, let's see what is the duration with an increase in market rate. So if there's an increase in market rate from 10% to 11%, the value of the bond goes down by 5%. So is it negative? Yes, because with an increase in market rate, the market value is going down. So what is the duration here? 5 times, which is a negative duration, which is similar to a plain vanilla bond. What is the duration with a decrease in market rate? If the market rate goes down by 1%, the value of the bond still goes up. It's just that the increase is very, very flat, is only just 2%. So in this case, if it's a callable bond, the average duration, if I take for 5 and 2, will be closer to 3.5. If it was a plain vanilla bond, this 2 would have been around 6 because the increases are more than the decreases. And then the duration would have been a lot more. So in both, whether it's a callable bond or a plain vanilla bond, the duration is negative. It's just that in case of a callable bond, the duration is lower. In case of a plain vanilla bond, the duration is higher. Now, if I look at convexity, I won't get into the full formula for convexity, but if I just take the numerator, what is the numerator for the convexity? What is the value of the bond with the decrease in market rate plus the value of the bond with an increase in market rate minus 2 into 100. So the convexity will be negative. That's what we have been saying so far. Because if it was a plain vanilla bond with a decrease in market rate, the value would have been around 106. And see, then the convexity becomes positive. But in case of a callable bond, because the increases are flatter, it won't be 106, it'll be just 102 or 103. And in that case, the convexity will be negative. If it was a putable bond, this 106 would have been 106, but the decreases would have been a lot flatter. It would not have gone down to 95. It would have gone down only to 97. So it's a positive convexity and the convexity is even higher. So to summarize, whether it's a callable bond, putable bond, or a plain vanilla bond, duration in all the three cases will be negative only. It's just that in case of a callable bond with a decrease in market rate, the convexity becomes negative. In case of putable bond, the convexity increases. It remains a positive convexity. It's a higher positive convexity.
So,
Yeah, Prakash.
so you mean to say that in callable bond, convexity will be negative because of the impact of that market rate or a price, whatever increase that not much as we expected. Like in plain vanilla, it will go to 106, and in callable bond, it will go to 103.
Yeah,
Is
102
it
or 103. Yeah. So the decrease is more, but the increases are less
less in the callable bond?
in case of a callable bond. So if you
So,
look at the formula is 95 plus 102 minus 2 into 100, they'll become negative.
okay. Are there only three plain vanilla callable putable bond, and are there any more products are there in
We'll
this?
also, we talked about convertible bonds as well, right?
Yes, sir.
And oh, in real market, there are too many of them, right?
Okay,
But
okay.
generally in here, we just talk about callable, putable, convertible.
Convertible. Okay.
Uh, it's very important, there's a very important consideration that all the convertible bonds have to be a callable bond most of the time. Can you guess why? I'll repeat, all the convertible bonds have to be callable bonds.
Because basically in convertible bond, that debt will be involved, sir. I mean, to convert the debt.
So remember, like convertible bond, we said that if you buy a convertible bond, you can get to the equity, you can convert into equity whenever you want.
Yes, sir.
But before you convert into equity, the debt is paying you very, very high interest rate compared to what you would have got in the form of dividend from the equity. You can keep enjoying the best of both the worlds, right? You'll keep debt for like next 10, 15, 20 years. And when you see that the equity price have gone up a lot, you'll shift from debt to equity. But to make sure that you do not have the best of both the worlds, the company will make it callable bond. Like not like from day one, but the company will say that, hey, if I want, I can call the bond back anytime after 5 years. So in this case, after 5 years, when the company sees that this person is not shifted from debt to equity, the company will make it say, hey, I want to call my bond back. And you have to surrender it within 1 month. Now, you don't want to surrender it, right? You want to convert into equity. So before 1 month, you will convert into equity. So technically, by making it callable, the company is forcing you to convert that debt into equity.
Sir, are the broker involved in this fixed income market, sir? Hello?
Sorry, say it again.
Are the broker involved in fixed income market, sir?
Yeah. So see, like all I would say is that fixed income market is a lot bigger, though it's similar to equity market, but it's 10 times more bigger than the equity markets. So just like the equity market, we have brokers for the fixed income market. There are big traders in the fixed income market, and it happens exactly similar to what happens in the fixed income equity markets. So we have exchange, we have brokers, we have got dealers, we have got traders. Everything happens similar to the equity markets. It's just that like you and me don't trade into these fixed income markets. So we feel like, it's a very small market. It's not that, developed and all, but it's a lot more developed compared to equity markets. By the way, Rakesh, I can't see you and others. Please don't be camera shy.
Yes, sir. There is some technical error in camera. I will log in through mobile, sir.
Sure. And I think, sorry, that was your question, right? Callable bond wala part.
Yeah.
Does it answer your question?
Yes, yes.
Great. So we discussed reading 62, which was about the credit risk. Now we're getting to reading number 63. The entire focus is on the government issues, like the bonds issued by the government. And obviously, we'll talk about the sovereign debt. Now, in this case, how do you know that what is the credit worthiness of a particular country? So, what do you look into it? So, the one and the most important thing is the policies within the country, right? Like, what is the fiscal policy? What is the monetary policy of the country? Or how is the economic data coming out, like the unemployment data, the inflation data? These are the most important things you will look into. Now, there's something called sovereign immunity. Like in this case, let's say if the government is not able, just let me read once. Okay, guys. So in this case, it's very important that you try to understand, like, what is the willingness, the character part. The reason being, like, if government says, okay, I don't pay you any, I'm going to default on you, you cannot go and file a case against government anywhere in the world. So let's say if RBI defaults on you, you're gone. Who will you file the case against? And where will you file the case? Right? So the character part or the willingness part is very, very important in this case. The second, so in case of like a company, if there's no willingness, you can force the company to the court and you can force them to make the payment, even if they are not willing to make the payment. But in case of government, if they're not willing to make the payment, they won't make the payment. The second part is fiscal flexibility, like whether the government has got some levers in their hand to collect more money from the economy to pay the debt back. How they can collect more money from the economy? Mainly through direct taxes and through indirect taxes. The third thing is the monetary effectiveness. What can they do to increase or decrease the demand and supply of money through monetary policy? How do they play with the monetary policy? We are going to do a lot of work on this in economics, but it's mainly through changing the interest rates in the market, the repo rate. It can be done through buying and selling government bonds in the market, and so on. The third thing is like another thing is economic flexibility. Now, if you have a very large number of people, like in case of India, you get lots of economic flexibility. So the math here is like even if you do something so that you can collect another 100 rupees per person in the form of income, given we have 150 crore people, that would mean 15,000 crore rupees more coming to the government, right? So that's like the advantage we got. The another advantage we have got in case of India is the developing economy. It means not everyone who should have access to something have access to that. For example, there are still some people, like not some people, there are like still huge amount of people who do not have access to bread and butter, who do not have their own house, who do not have their own business, who do not have their own employment, blah, blah, blah. So think about when all of these people have what they want, think about, the growth the economy can see. So in case of India, like, generally there is lots of economic flexibility in terms of growth trends, income per capita. Like I would say like maybe Japan is saturated from that perspective. What else can they do? Everyone who should have a car have a car. Everyone should who should have access to the bread and butter have the access to bread and butter. Everybody has their own house. What else can you do? Are they growing in terms of like the population? No. Are they a developing economy? No. It depends a lot on the what's your external status factors. One is like how others perceive you like as a world economy, right? So if you are a big economy like China and India, other countries may will have more respect for you compared to let's say a smaller economy like Afghanistan. Maybe like they would not have that much of status in the entire world. Not only that, this external status comes from the reserves you have, the reserves in the form of currencies and gold. So China has got lots of these reserves, by the way. No wonder, they get more respect compared to any smaller country. India has got lots of currencies and gold reserves. They get respect. Now, guys, there are some quantity, like everything we did above is a bit qualitative. In terms of quantitative, you can look at few things. One is in case of companies, we look at debt to revenue ratio. Here also you look at debt to GDP ratio. It means how much debt the country has taken divided by what is the country's annual GDP. So let's say India has taken a debt of 3,000 crore rupees and their annual GDP is, let's say, 1,000 crore rupees. It means if India wants, they can pay the entire debt within 3 years from the GDP they're generating on a yearly basis. But if the same 3,000 crore rupees debt has been taken by a smaller economy where the GDP is just 100 crore rupees, they'll take 30 years to repay the debt, even if they use the entire GDP to repay the debt for the next few years. So that ratio is very, very important, that how much debt you have taken versus the GDP of the country. The second one is economic growth and stability. So as I was telling you about, given India is a developing economy, the GDP growth rate is a very important part. So let me explain you this, guys, okay? Let's say there are two companies, or let's say there are two countries, A and B. Both of them has taken a debt of 3,000 crore rupees. ठीक है, दिस इज द डेट. नाउ कंपनी ए का जो जीडीपी है, कंपनी ए's जीडीपी टुडे is just 500 crore rupees, and company B's GDP is equal to, let's say, 1000 crore rupees. Now it may look like that it's safer for B to take a 3000 crore rupees. If you look at the ratio, debt to GDP ratio, in case of country A, because both of them taken a debt of 3000 crore rupees, the ratio here is 3000 divided by 500. 3000 divided by 500. So the ratio is 6 times. And if I do the same thing for country B, the ratio is 3 times. So the country B has a more flexibility to give the loan back within 3 years if they use the entire GDP to repay the loan. So I would say that country B is less risky, given they have taken a smaller amount of debt for a given level of GDP. Both of them have taken the same amount of debt, but just that B has a higher GDP. So as a ratio, it turns out to be lower. But let's assume that going forward, India being a country A is going to grow at a much faster pace, let's say 10%. And country B is a developed economy, so they're going to grow at a very small pace, which is just 1%. And if I pull it forward by another 5 or 10 years, look at the ratio, what will happen. The ratio looks like 6 in case of country A, but over a period of time, this ratio will decline towards 1.58. The reason being, country A's GDP is increasing much faster. But if I look at the ratio for country B, it was 3. It will also reduce, but it will reduce to only 2.61. So it may look like country A is taking lots of debt today, given the GDP of the country. But given their GDP is going to grow very, very fast, as a lender, I'll feel more safe looking 5 years or 10 years down the line to give that 3000 crore rupees to country A, despite they having a much lower GDP. Because eventually 5 years or 10 years down the line, country A will have more GDP compared to country A. Is that logical? So that's the reason the growth part becomes very, very important. And that's the next thing, higher real GDP growth rate, economy size. Why the economy size matters? Because if your economy size is huge, you become safer in the sense that larger the company is, safer it is to invest. Similarly, larger the country is in terms of the GDP, in terms of the wealth, it becomes less probable for that country to fail. So guys, during COVID-19, lots of small companies, lots of startups failed, right? Well, they did not have that much of muscle power. They did not have that much deep pocket. But did the largest companies in the world, did they become bankrupt? No, obviously not. They have got deep pockets. They can sustain those downturns for a longer period of time. And the third thing is external stability. Again, you're looking at the reserves and the surplus you have in terms of the foreign currency and in terms of gold as a percentage of the debt you have taken. So take a scenario, like let's say I've taken a debt of 1000 crore rupees from the US. Okay. And the biggest risk here is that if I've taken 1000 crore rupees debt in the form of dollars from the US government, what if INR depreciates? So let me give an example here. India as a government can take India INR based debt, or they can take a USD based debt. If they take an INR based debt, I don't care, because I can never default on the INR based debt. Do you agree with that part? A country can never default on their local currency debt. Why?
Because they can print their own monies.
Yeah. So even if country's GDP is 100 crore rupees and they've taken a 10,000 crore rupees debt, They will never default. They'll just print more currency. The problem is that when they print more currency, the INR will depreciate, right? But how does
Yes.
government care? They have to return 10,000 crore rupees back to the lender. It's just that lender, when they gave the loan to Indian government, INR was worth 80 rupees. Sorry, 80 rupees was equal to $1. But because Indian government printed so much currency, now to buy $1, the lender will have to pay 150 rupees. So INR has depreciated like crazy. But did government technically default on it? No. Is it a loss to the lender? Yes, because the INR has depreciated a lot more. But think about if it's a USD based debt, and the country has taken, let's say, a similar debt on the USD based debt. The problem here is that in this case, India can default because even if they print more INR to buy dollar, as soon as they print more INR, the value will become lesser. So there is a possibility that even if they keep printing INR, like, the Indian government say, hey, I'm introducing a 10,000 rupee ka note, and they keep printing that 10,000 rupees ka note day in, day out. Still, there's a possibility that they will not be able to pay this USD based debt. The reason being that as soon as they print more currency, the value of the currency will go down. So take a scenario, currently they have got 100 INR and the exchange rate is 80. So they will be able to buy how many dollars? They'll be able to buy 1.25 crore dollars. But as soon as they print more currency, rather than 100, they'll have 200 INRs. But the possibility is that the exchange rate will come down to 160. As a result, how many dollars they will be able to buy is still 1.25. But how much they need to pay back is 2 or 3. Will they ever have that much of debt, US dollars, to pay the money back? Maybe not. So in case of foreign currency debt, there's a chance of a default. In case of a local currency debt, a country can never default. In case of local currency debt, though the country can never default, the lenders can still incur a loss because the currency has depreciated quite significantly since then. Now, everything we discussed about was the sovereign debt, which was issued by the central government. Now, there could be non-sovereign debt, which is not issued by the central government, but issued by other parts of the government. It can be issued by some agencies of the government. For example, in case of India, let's say LIC issuing a debt. It's very, very similar to Indian government issuing a debt, right? It can be issued by government sector banks. Like, in case of India, it could be issued by State Bank of India, Canara Bank, Bank of Baroda. There could be supranational issuers. Like, it's just not one government, but multiple countries' government coming together and issuing a debt. The example could be World Bank. It could be issued by the regional government, as in like maybe a state government or a municipal government. In this guys, we already discussed about the general obligation and the revenue bonds, right? So if a municipal organization issues a bond, these bonds can be general obligation bonds. It means that, let's say if I'm a BBMP, which is a Bangalore Municipal Corporation, if I take money from you as a part of general obligation, it would mean that if I'm taking 1,000 crore rupees from you, I'll pay you 1,000 crore rupees from the overall income I'm generating. So you should look at my overall income level, overall wealth level before you give a loan to the Bangalore Municipal Party Corporation. But if I say that it's a revenue bond, then you should be asking me, okay, where do you think you'll be investing this money into? If I'm going to invest this money into, let's say, a construction of a flyover and I'm going to collect tolls from there, I'm going to give you the money back only from the revenue I'm going to get from that flyover. So your focus is not about how good I am as a municipal corporation. Your focus is about how good that particular project is and where the project will be profitable so that I'll be able to give the money back to you. So I think we discussed about it already, but that's a very important difference between general obligation and revenue bonds. In case of general obligation, your focus is on the health and the wealth of the municipal corporation. In case of revenue bonds, your focus is on the project in which your money will be invested into. So guys, it was more of a recap of everything we've done in before, but it's a bit more detailed. That's it. We are getting into corporate issues. We'll do similar qualitative and quantitative stuff there. In case of companies, the most important thing is you look at the business model. What do you mean by business model? Let's say if a company is into a business model which you think is not going to be a great business going forward, I will not give a loan to that company. So let's say if there's a big business who starts, I'm just giving a very one-off example. So let's say somebody said, like there's so many people who wants printouts, and I want to open a big shop where you can take lots of printouts in a very fast pace. You can take the printout on A5, A4, A3 papers, color printouts versus black and white printout, everything. And I would say, like, I want to invest into that business. Do you agree with that? How many printouts you used to take 10 years back versus the number of printouts you take today? How many times have you submitted your 100-pager, like case study or the project, academic project in school in the form of printouts? Do you take printouts and submit? What do you do these days, guys? Anybody who did college recently and had to submit like a big
PDF.
50, you send a PDF? But I remember,
Yes.
guys, like that used to be an additional cost, like, rather than having one packet of cigarette, you have to spend that money to go and take the printouts of a big report in a nice glossy pages and submit it to the professor. And we used to wonder, like, अरे यार सही है professor कितना मतलब, like he would be getting a big amount of money just by selling it in scrap. Like they're like, 300 people submitting that big report in a printout form. Such a waste of money, right? So the business model, when we say, is about what is going to grow further. So like if somebody is, like investing money into having the power stations where you can charge electric vehicles, wow, that's a nice business model. If somebody's investing money into getting recyclable plants to, like recycle some of the waste material, yeah, that's a nice model. So, like what your business model is, that's very important. How safe it is, how regular cash flows are there, that's very important. So if somebody says that, hey, I'm a milk vendor, I make 1 lakh rupees every month. A milk vendor got 1 lakh rupees last month. Even if the markets are very bad, how much it will be next month if the markets are very bad? Still
Like
1 lakh, right?
like 80,000. They're not very far from 1 lakh.
I'll say not even 80,000. Like, have you ever stopped your milk supply at your home? Even if, let's say, I lose my job, I don't think like the milk supply is that will be the last thing I'm going to stop, right?
Yes.
So the stability of the cash flow, that's very important. But let's say it's not a milk vendor. Let's say this is about a person who is selling uh, gifts in the market, gift shop. Markets are good. Everybody's buying gifts. Oh, I have to give gifts to my sister, my brother, my mother, my father, my friends. Oh, when there's a recession, अरे यार क्या जरूरत है gifts का? Who cares about it? So that's very discretionary, and you're going to stop the spending on that the very first thing. So when we say business model, it's about what do you think about the future of that business, the growth in that industry, how predictable the cash flows are, and all of it, to take an idea whether you should be investing in that business or not. So the business model will define the capacity for the company to pay the money back. Okay? Industry competition, you're in a right industry, you're in a right business model, but the competition is so much that you'll not be able to compete. So simple सा फंडा है, anything which you think will be done by Amazon, Google, Microsoft, in next 10 years, don't get into that business. Right? Or the best case scenario is if you get into those businesses, the best case scenario will be bought out by those companies at the valuation they want. That's the best case scenario. The business risk, like, is more about the company specific risk, like what is the risk of like revenues falling down, the margins falling down, the profitability coming down, and as a result, the company not able to pay the money back to you. Corporate governance, we'll have a lot of discussion about it when we get into corporate finance or corporate issuers as a topic. If you're not done it already, in case of corporate governance, it's a lot about what are the issues in terms of the company's board of directors, management, and whether the people in the board of directors are independent directors or not, whether the board of directors and the management are working for the shareholders or not. So this is a big topic in corporate issuers. So there could be environmental issues, social issues, and governance issues. Not only governance issue, even the environmental and the social issue. Together, they are called ESG, is a very important consideration when you invest money in a company, because if the company defaults on ESG, the repercussions are pretty huge these days. Did you see this Rameshwaram Cafe wala part? Like in Hyderabad, they found some expired products. I'm a very regular visitor to the one in Bangalore. And you can see, like when these kind of news come in, you can see a decrease in the footfall because people care about it. And see, if that was like 15 years or 20 years back, something similar would have happened. How many people would know it sitting across the world that this something happened in Hyderabad? No. But now the media, like things go viral like crazy, right? So these days, like these things take a very important stand because it impacts your business. There was a fire in Rajkot, right? The gaming center. You know what? In my like, I've got some family in Rajasthan at various places. There are lots of raids happening in those places because something happened in Gujarat. There was a relative of mine running a small restaurant here, and this food quality people came and saw that like the place at which they were washing the utensils was not very far from the place they were cooking the food. The restaurant was closed. So all I'm trying to say is that the repercussions are so huge these days. The media gets so much of attention that it's just not like acha yaar theek hai hoga to kar lenge warna who cares about it. People care a lot about it. तो आज से 20 साल पहले if that would have happened, trust me, like the food quality officer would say, okay, pay 1,000 rupees and make sure that you don't do it again. But now the restaurant is closed. So when we say corporate governance, like the best example would be Satyam. Just because they were manipulating the accounts and there was management, and the board coming together to manipulate things, the repercussion was not just like the stock price went down by 5% or 10%. The company became bankrupt. So that's very important. Now, covenants we already discussed a lot about, like what are the terms and conditions, and the accounting policies we discussed about. But just like we did in case of government, the quantitative factors, it's much more easier in case of company because we are going to discuss a lot about it when we get into financial statement analysis. So what are those things? The most important thing we look at is coverage of debt. So what do we look in case of coverage of debt? We look at net debt by EBITDA. Net debt is nothing but debt. EBITDA, if you don't know what is EBITDA, is nothing but the company's profitability. So in case of a country, we look at debt by GDP. In case of a company, we look at debt divided by company's profit. Okay? That's one way to see how much the company can raise money from the market in the form of debt. So if my profit is 100, maybe I can raise 200 or 300. But if my profit is 10, can I raise 200 or 300 from the market? No. Liquidity, let's say I don't have profit, but I've got lots of money in the form of debtors, in the form of inventories, which is lying with me. And if I come to one of you and say, hey, can you give me 1,000 crore rupees? What is my profit? I don't have profit, but I've got lots of other assets which I can sell and give the money back to you. You can still trust me with your money. And the main part is profit. Higher the profit I generate, more is the loan I can take from you, and the more you will trust me. But the profit will decide my capacity. Now, guys, this is what I was talking about: EBITDA, CFO, FFO, FCF, RCF. We're not going to discuss anything about it because we are going to do a PhD in this when we get into financial statement analysis. Everything will be discussed there. EBITDA, CFO क्या होता है, FFO क्या होता है. Discussing it now doesn't serve the purpose. Priority of claims, it can be senior versus junior. Senior rank bonds will be paid first ahead of the junior rank. Secured debt versus unsecured debt. Secured debt has a mortgage. Unsecured debt doesn't have a mortgage. So if you look at the hierarchy, the loans with the mortgage will be paid first, then the senior, then the junior, then come the unsecured debts. Within unsecured, senior unsecured will come first, and the junior and the subordinated debt will come next. So secure comes first before unsecured, and the senior comes first before junior and subordinated. Pari passu we discussed yesterday already that in case of a default, all of these bonds will have a similar hierarchy. There's a concept called notching. So as I told you, right, like a credit rating agency, they have a AA rating and they want to downgrade the rating from AA to A. But before they do it, they first of all will say, hey, on AA rating, we have a negative view on AA rating. So from AA, you're going to AA minus. And once your negative view continues, you go from AA minus to A plus. So this is called notching. Like you're not going from AA to A. There are three notches from AA to A. First of all, you go from AA to AA minus. From AA minus, you go to A plus. And then from A plus, you go to A. So each step is called notching. Okay. So now the last three topics, which is about securitization, this is a bit tricky. And I'm going to do it in a lot more detail just to make sure that you understand the logic of it. So reading 65, reading 66, reading 67, all these three readings are based on a similar example. And I'm going to do that example in a very, very proper manner. It's going to be a bit complicated. It's going to be a bit technical, but I'll try to do it as simply as possible so that you can understand the logic of it. Let me repeat. The next three topics are going to be based on this example. So if you do not understand this example, ask me questions. Okay? So I'm going to make a setup. Like there are multiple parties into this setup. Why, what each party is doing, what is the logic of what party is doing, how does it serve the customer, how will it make the profit to the party itself, and I'm going to create the entire setup here. And this setup you should understand for all the three topics we are going to do from reading number 65 till reading number 67. Okay? Let me ask you a question. Any of you have a bank account with Goldman Sachs? Any of your friends, relatives? Have you seen a branch or an ATM for Goldman Sachs? They're a big bank, right? One of the best banks. So what I'm trying to say, guys, is there are some banks which are into retail. We call them retail banks. But there are some banks which are investment banks. They have nothing to do with retail. So the example of a retail bank for which you would have seen multiple bank branches and the ATMs, and you would have your bank account or your family and friends have a bank account, will include ICICs of the world, HDFC, SBI, IDFC, Axis Bank, and all of it. These are retail banks. What are the investment banks which are not into retail? It can include Goldman Sachs, Credit Suisse, Morgan Stanley. There's so many. Now, there are some banks which have a retail banking as well as investment banking. The examples could be, can you give me some example? I've got a couple of examples.
JP Morgan Chase.
Very good. JP Morgan. Like they do not have the
HSBC.
retail presence in India, but yes, they have a retail presence. HSBC is, yeah, they have got lots of retail and lots of investment banking.
City.
Citibank, yeah, that's like another one.
Deutsche, I guess.
Deutsche Bank have got a very little retail presence, like at least in case of India. But yes, I've seen their ATM, I've seen their bank. So yes, Deutsche Bank. And that's the reason I did not put any of it in here, because they have got these banks. I've never seen any retail presence anywhere in the world. But these banks, they're pretty big in some cases in terms of their retail presence. Okay? So it's very important for you to understand what are the retail banks and what are the investment banks for this purpose. Now, in this case, these investment banks wants an exposure to the, let's say, the loan market. Let's say they want an exposure to the housing loan market. So think about Goldman Sachs thinks that the housing prices are going to go up. So if there's a customer who has taken a home loan, it means if that person has taken a home loan, has bought a house, and the housing prices go up, is it good for the customer? Yes, it's good, right? What's like if I'm the person who's the owner of the house, even if I've taken a home loan, how do I care? If the housing prices are going up, it's my profit, right? It's not bank's house, it's my house. Any doubt about it? That's very simple, guys. If a customer owning a house, the housing prices go up, it's good for the customer. I don't see any doubt there. But my question is, let's say if this customer has taken a loan from HDFC Bank. HDFC Bank has just given a loan to this customer for that particular house, and the housing prices go up. Is it good for the bank?
Yes, sir.
Why do you think yes, Ansh?
Sir, because of higher cut.
तुम्हारा आवाज नहीं आ रहा है.
Sir, because of higher cut.
Higher?
Higher cut. Sir, they have more amount of mortgage.
Exactly. The amount of collateral is more. So the chances that HDFC is going to lose money in this deal is very, very less. The risk has come down. The customer का character same है, capacity same है, covenant same है, but collateral का value बढ़ गया. So guys, in case of a loan market, let's say if I take a loan of 1 crore rupees, and if I give my collateral, let's say if I give gold as a collateral, तुमने सुना होगा, right? Gold loan होता है market के अंदर. If you give a collateral gold of 1.5 crore rupees, you know what the lender is thinking? Yeah, there's a chance that the gold prices can come down a lot, right? If the gold prices become half, will I be able to sell the gold and recover my money? No. So at some stage, I have to trust the character and the capacity of the borrower. I cannot rely on the gold entirely. So every time a lender lends money, collateral is just a backup plan. My main plan is the borrower will give me the money back because of the character and the capacity. Collateral is a backup plan. Covenant is a backup plan. I'll drag you to the court if you don't pay me the money. That's not my number one plan, right? I don't want to get into these things. So as a result, think about if the total gold I have to put is 5 crore rupees to take a loan of 1 crore rupees. Do I have to trust the borrower? I don't care about the borrower. Oh, you get drunk every day, you smoke every day, you're jobless. I don't care. You're giving me 5 crore rupees ka gold for a 1 crore rupees ka loan. Even if the gold price becomes half, even if the gold price goes down by 70 or 80%, I don't care. So this is the benefit of over collateralization. So this is what we call as over collateralization. That the collateral you are taking is multiple times of the debt you have given to the borrower. So in this case, let's say the customer had taken a house worth 1 crore rupees and HDFC has given a loan of 90 lakh rupees. What do you think the HDFC bank is doing? Are they just trusting the collateral or they are also trusting the borrower?
They're trusting the collateral, sir.
But guys, like, what are the chances that the 1 crore rupees ka house will be sold for 1 crore rupees? Let's say if the value of the house goes down. Let's say the builder does not deliver the project in a correct quality or in a pre-decided quality. Or we are in the world where the builder doesn't deliver the project at all. So there are lots of risk, right? So in this case, HDFC Bank is trusting a lot on the customer's salary, customer's income, and other things. Collateral we have, but that's a good backup option. But guys, in case of home, there's a mandate from the central government that be a bit lenient in terms of giving a home loan. So that kind of give a push to the infrastructure within the economy. That being said, many a time this collateral may not be good enough to repay the loan. But let's say this housing price becomes 2 crore rupees. Then I don't care about who the customer is because I'm pretty sure that this 2 crore rupees ka house will any day be sold for 90 lakh rupees. So what I'm trying to say is that if housing prices go up, is not only good for the bank, not only good for the customer, it's also good for the banks. Because they continue to get the same rate of interest, but their risk associated with the loan goes down quite significantly. So guys, this is an entire scam. Think about if your house value is 1 crore rupees, this is what happens at the start of the loan, right? What is the loan amount? The loan amount is 90 lakh rupees. So the bank says, hey, the risk-free rate is 7% or 6.5%. Oh, by the way, guys, I take lots of pride. My CIBIL score is more than 800, like one of the very good ones. Your CIBIL score goes up if you take too many loans and pay them on time. So not that I'm paying on time, but I'm taking too many loans at the same time. So in this case, the interest rate I would get here is 9%, which I believe is very, very high 8.6%, which I believe is very, very high, given like 2.1%. But that's okay. Given the amount of collateral I've given is just 1 crore rupees, which is slightly more than the loan amount I've taken. But what do you think will happen 5 years down the line? This 1 crore rupees might become 1.2, 1.3 in the worst case scenario. The loan amount, 90 lakh rupees, will become 60 lakh rupees because I've repaid some amount of it. Do they reduce the spread between this and this? No, they keep the spread same. So with each passing year, actually that become a very, very safe loan for them. And like 10 years down the line, this 1.2 might become 1.5 and this 60 might become 30. See the over collateralization. The bank is very happy They can always go and sell the house for 30 lakh rupees if they want it. But the interest rate they're charging me is still 2.5% more. So with each passing year, the home loan becomes safer for the bank who has given the loan. Because the value of collateral keeps increasing as a percentage of the loan what the bank has given. So there's a scheme here, like after 3, 4, 5 years, you can go and do a bank transfer, like the loan transfer to another bank. You'll always get a better deal. Okay? Any which ways. Is it clear that if the housing prices increases, it's not only good for the customer, but it's also good for the lender? And you can take a home loan only from the retail banks like ICICI Bank, HDFC Bank, SBI Bank. Goldman Sachs can never give you a home loan because for that they have to have a retail branch, they have to have a customer care, they have to have a lots of facilities, but they don't have those facilities. And the problem here is Goldman Sachs has a very, very strong view about the housing markets in India. So they want to have the exposure to the home loan market. Even they want to give loan to the customers, but they don't have a retail presence. What do they do? So the Goldman Sachs has got lots of money from their investors. They want to invest into housing, not like buying their own house. They want to invest that money in terms of giving loan to other people who wants to buy their own house. And when the housing prices go up, those borrowers will benefit, but even Goldman Sachs will benefit if they've given a loan on those houses. Are you able to understand? But how does Goldman Sachs get its exposure when they don't have a retail presence? It's difficult, right? So Goldman Sachs and its investors are losing out on a very big opportunity, which is retail oriented. And why only home loan? What about a car loan? What about a credit card loan? What about a mobile loan? आज के दिन वो भी मिलता है, right? So these investment banks are losing out that exposure on these kind of loans. They can get an exposure, but the cost is huge. They have to get into retail, which they don't want to. So we have an entire structure here, and you'll be able to appreciate that structure a lot more. So what will happen is, in this case, HDFC as a bank, for example, you agree that HDFC will have lots of loans in the market, which they have given to the customers. So let's say HDFC has given 1 crore rupees ka loan. Just give me 1 second, guys. Sorry, guys. So let's say HDFC has given like hundreds of loans to hundreds of different customers. So let's say A को उन्होंने 1 crore rupees का लोन दे दिया, B को 1 crore का दे दिया, C को 1 crore का दे दिया. I'm just keeping it simple. And this way HDFC has given a loan to 1,000 people, and the total loan amount is 1,000 crore rupees. That's doable. And let's say the interest rate what HDFC Bank is going to charge from these people is 9%. किसी से 8.5, किसी से 9.5, but on an average, HDFC Bank is going to charge them 9%. Now, what HDFC Bank is saying is that, okay, the total money I had, I've already given that money in the form of loan to these people. I don't have any money left. So what they will do is they will put all these 1,000 files in kind of a carton box. And they will say that whoever buys this carton box will get the money from these customers when they pay their EMIs back. So think about they putting all the 1,000 policies worth 1,000 crore rupees in a carton and go and sell it to a investment bank. Investment bank को तो पका पकाया मिल गया, right? They don't have to deal with the customers. They don't have the retail presence, but they'll simply buy this carton. Obviously, like they won't. HDFC Bank is not stupid to sell this carton for 1,000 crore rupees. They'll sell this carton for, let's say, 1,020 crore rupees to the investment bank, like to the Goldman Sachs and to the Morgan Stanley and to the Credit Suisse of the world. How does it benefit the HDFC Bank? Now, when they get this 1,000 crore, 1,020 crore rupees from the investment bank, they'll again go and give the loans to these people, to other 1,000 people. So they'll keep 20 crore rupees in their pocket and give loan worth 1,000 crore rupees to more and more people. Again, they'll make a carton. Again, they'll give it to another investment bank. Investment bank को क्या फायदा है? Without their retail presence, they got an exposure to those home loans. Is that logical? What the investment bank will do? Investment bank has got some clients and the investors who have put the money with the investment bank to be invested in the market. So the bank will take those clients' money and apportion this 1,020 crore rupees to different clients. So in this case, a typical thing would be, and let me go a step back.
Can you please repeat the last part?
Yeah. So in this case, I'm saying there are multiple parties involved. One is the homeowner who is going to buy the home. He's going to take a loan. So let's say homeowner is like one of us. Let's say Varun is the homeowner. Varun is taking a home loan from a bank. So this is what we'll call as a lender, which is HDFC. Oh, by the way, between the homeowner and the lender, there will be a broker as well. In case of India, the brokerage is very limited. Many times Varun will directly go to HDFC, but you go to the US and all, everything is done through a broker. Okay? So this is what we call as a bank broker between the borrower and the lender. The lender, then there's an investment bank who will sell this entire lot to any investment bank. In this example, let's say this is Goldman Sachs. So the last example, what I'm saying is the HDFC Bank will take all the 1,000 files and they'll sell these 1,000 files to the investment bank like Goldman Sachs for 1,020 crore rupees. What's the benefit to HDFC Bank? They got a profit of 20 crore rupees straight away. What's the benefit to investment bank? Though they're paying a bit of premium, but eventually they got an exposure to the home loan market. And as a result, when the home prices go up, Goldman Sachs will benefit. What Goldman Sachs is going to do is Goldman Sachs has got many investors who has given the money to the Goldman Sachs, and the Goldman Sachs has to invest their money on their behalf. So what Goldman Sachs will do is they will say that, okay, 1,020 crore rupees, there are 1,000 different loans. Now, I would not see those 1,000 different loans as 1,000 different loans. I'm seeing it as a package. So that package is worth 1,020 crore rupees. Why do I look at it as a package? Let's say one of the loans is given to Ansh Agarwal and that person defaults. So anybody who has invested 1 crore rupees in that loan will have a huge risk. But let's say if you put 1% money in the entire package, and if one of the person fails, you won't even feel the pinch. So the diversification happens. The risk gets diversified. So now I'm not looking at individual loan. I'm looking at it as a package. That package is worth 1,020 crore rupees. Goldman Sachs will say, hey, I'm going to divide this package in the form of shares. So this package, I'm dividing into, let's say, 102 crore shares. So each share is worth how much? 10 rupees. So just like you buy the shares in the company, you can buy the share in that package. If you invest 100 rupees, you'll get 10 shares. If you invest 1 crore rupees, you'll get 10 lakh shares because each share is worth 10 rupees. So the investors will buy the shares in this package depending on the risk requirement, blah, blah, blah. I'm going to make it more complicated. So before I do that, so in this case, there are clients or the investors with investment banks. So technically, initially, homeowner wanted money. They went to a bank broker. HDFC lended the money from their end. They sell the package to Goldman Sachs or the investment bank. The investment bank takes the investment from the investors. And this cycle keeps going on and on, guys. It's just not one-time cycle. Again, HDFC Bank got more money. Again, they make a package. Again, they sell it to the investment bank. The investment bank again sell it to the investors. Again, the money comes to the HDFC Bank. Again, they make more package. Again, they sell it to the investment bank. And the investment bank sell it to the investors. Okay? So do you understand all the 5 parties? The homeowner, the bank broker, lender, investment banks, and the investors with the investment banks. So technically, who is giving the money? These investors are giving the money. Who are these investors? The large investors, like the insurance companies, the pension funds, right? It could be the large NRI investors, HNI investors. Oh, NRI and HNI are one and the same thing, by the way, these days. And who is taking the money eventually? The homeowners are taking the money. All of these are intermediaries, technically. They're just getting nice commission and getting out of it. Now, before we go further, take a separate chain of thoughts. I'll give this analogy, and I think I've discussed this analogy in the past, but let's say there is a mango. Oh, mango ka season chala gaya abhi. Lychee season. Lychee vendor. Right? There are 2 types of vendor. एक vendor होगा fruits वाला. वो क्या करेगा? They'll have a big heap of lychees. उसके अंदर, you know, like some lychees are not proper. They are rotten. Some of them are very, very small. Some of them are not red enough. But some are very nice, big enough. So it's a mixed lot. So this lot, this lychee vendor is selling for, let's say, 150 rupees. Oh, sorry, I'm outdated. 300 rupees per kg. And you'll say, take a fair deal. And you'll try to pick like some nice ones from here. The lychee vendor will say, no choosing. You take the entire lot, kind of a thing, right? And this case, let's say lychee vendor has got 100 kgs. And if this lychee vendor sells 100 kgs for 300 rupees, at the end of the day, he'll make 30,000 rupees. But the people who cannot afford 300 rupees will not buy this. People who want a premium one, I don't want to get like, you know, these small ones, not red enough ones. I want to buy only the premium ones, will not buy this. People like you and me will buy this, right? Who can afford, but cannot afford too much. Another lychee vendor, what he does is, he separates this entire heap into 3 parts. He keep like the inferior ones into one heap, which are small, rotten, not red enough, into one heap. Let's say out of 100 kg, that's roughly 20 kgs. And he'll sell it for, let's say, just 100 rupees per kg, very cheap. He'll make another lot, which is 30 kgs, which is like not bad, but not good either. And he'll sell it for, let's say, 150 or 200 rupees per kgs. And then the remaining 50 kgs, which are the nice, lumpy, red, big ones, and he'll say, I'm going to sell it for 500 rupees per kg. You seeing the point? By dividing that into 3 heaps, you got a customer for each and every heap. The premium ones, like the people coming in Mercedes and Audis, were not buying this one from you. But when they see this heap, they'll be more than happy. There's some like, daily workers, who couldn't afford this heap, but now they can buy something from this heap. But in this case, guys, try to think that they will get 2,000 rupees from this heap. That person will get 6,000 rupees from this heap and 25,000 rupees from this heap. The total money this person is getting is not 30,000, but 33,000 rupees. And it's just not about 3,000 rupees more. Maybe there's a chance that I'll be done with selling this heap faster compared to this person. Do you agree with that? Oh, why am I discussing a lychee vendor all of a sudden? This 1,020 crore rupees will not be sold as a single heap, as a single package. The investment bank will divide this package into 2, 3, or 4 different heaps. What are those heaps? Maybe the investment bank will say, okay, the best heap, which is like all the salaried people with a CIBIL score of more than 800, who has never defaulted in the past, that's like your best quality, high quality heap. Medium quality heap, where the chances of default are there, but it's not that much. And then there's a low quality heap. The customer is going to pay 9% to HDFC. HDFC will pay that 9% to investment bank on the entire package. So as soon as the money comes from the customer to the HDFC bank will pass on that money to the investment bank. And the investment bank will pass on that money to the investors. Now, guys, so much is going on with my loan car file in the background. But do I bother about it? No. Do I know about it? No. Because I'm liable to pay to HDFC Bank. HDFC Bank is liable to pay to Goldman Sachs. Goldman Sachs is liable to pay to the investors. So in this case, investors are going to eventually get 9%. But in this case, the person or the investors who buy this high quality heap, they should not get 9% because the risk they're taking is less. They'll get only 5%. But the people who are taking low quality heap, they're taking more risk. They will get 15% return. And the people who are medium quality, they'll get 10%. So guys, who will invest into the high quality heap? Who doesn't want to take risk? Who are the safe investors? Who will take the low quality heap? Who wants to take more risk? And these are the high risk investors. Who are the high risk investors? The best example is a hedge fund. They want to take more risk. So you divide this 1,020 crore rupees ka package into 3 parts. When you divide into 3 parts, you make a share out of it. जैसे यहाँ पे 1,020 crore को तुमने you divided into 102 crore shares, right? Similar thing you do in case of high quality heap. So rather than dividing it here, let's say the high quality heap is worth 400 crore rupees. You'll divide into 40 crore shares of 10 rupees each. This heap is worth, let's say, 300 crore rupees. You'll divide that into 30 crore shares of 10 rupees each. And the same thing with the low quality heap. So guys, technically, if you ask me, the bank broker would have made nice 30, 40, 50,000 rupees on a loan worth 1 crore rupees because that person connected the homeowner with the bank. The bank made a nice 2% commission because they found the customer, they did the processing, they have the retail presence, they attracted the customer, and they gave that customer to the investment bank. Investment bank will sell this 1,020 crore rupees ka package to the investors for maybe 1,050 crore rupees and make another 30 crore rupees ka commission. And investors ko fayda hai that they're getting an exposure to the home loan market and they're getting a 5% return, which is much better than what they would have got even if they've invested the money in a very, very safe investment. In case of the US, I'm talking about, sorry. यूएस के अंदर किसी को अगर बैंक में जाके पैसा जमा कराएगा विल गेट 2%, 3%. यहाँ पे they're getting 5%. And the chance of these people defaulting is near zero. So guys, this market is a huge market, and this is what we call as Securitization. What do I mean by securitization? That you're creating a security out of a loan. Loan for a homeowner is a liability, but for a bank, it's an asset. It's an asset in the sense that either I'll get my money back or I'll get a house. So that asset, I'm creating a share out of that asset. जैसे me and my friend in my college days, we opened a venture. तो हम लोग क्या करते थे कि we were writing the CFA exams, so we were selling the CFA calculators. So what we used to do is used to buy it in bulk from Texas Instrument, and we were able to sell it at a much cheaper price compared to what it was available in the outlets. And thank God there was no Amazon and Flipkart at that point of time. We used to make like 200 rupees per calculator, good enough for us to have a Maggie and a packet of cigarette if we sell one calculator. And we're not mugging anyone. We were just saving on the transportation cost and the bulk discount we got. So in this case, the partnership we had was like I had a 40% because I was less involved and I was not putting my own money. And my partner, like my friend, had a 60% stake in it. So that's also securitization, right? The asset being the venture, 60% is being owned by my friend and 40% being owned by me. In this case, the entire package, maybe if 2% is owned by one mutual fund, 1% is owned by another mutual fund, 3% is owned by hedge fund. But the hedge fund will be owning this particular heap. The mutual fund will be owning this heap. The pension fund will be again buying this one. Insurance companies will be buying this one. Right? So this is what we call as securitization. Public companies mein kya hota? Let's say Tata Steel. If I get 10 shares in Tata Steel, am I owner of Tata Steel? It's just my ownership is what? 0.000001%. So when we use the word security or the ownership, you're just dividing the particular asset among multiple owners. In that example of the venture between me and my friend, there were just only 2 shareholders. In case of a public company like Tata Steel, there are crores of shareholders. Similar to Tata Steel, in this case, there will be lots of shareholders in the market. Oh, it doesn't end there. Let's say if HDFC Bank wants the money back from the customers, can they say, hey, give me my money back? They can't. I'll say, dude, I'll pay you only EMI and get lost. Beyond that, I'm not liable to pay you anything. You need money, but I won't pay you money. So think about housing prices go down. Everybody's defaulting. COVID-19, people lose job. HDFC Bank will say, no, dude, give me my money back. I don't want to give you the money. Can they go back? No. But in this case, given these investors have bought 40 crore shares of 10 rupees each, and not a single investor bought it. The many investors who bought it. Some people bought 1 crore shares, some people bought 2 crore shares, and all of it. In this particular heap, you can buy and sell shares among yourself. So there's a bit of liquidity in the market as well. So when you create shares, you get liquidity. More the number of shareholders, more is the liquidity. Between me and my friend, will it be easy for us to sell a stake in that business to somebody else? Will be very difficult. But can I sell my shares in Tata Steel to somebody else? It's very easy. So in this case, it won't be as easy as Tata Steel, but it won't be as difficult as the private venture me and my friend had. Make sense? So guys, it helps the homeowner that, now rather than 1,000 homeowners, there will be 10,000 homeowners who can be serviced by HDFC Bank. It's good for the broker. The more deals, they're getting more commissions. It's good for HDFC because every time they sell a package, they get 20 crore rupees. It's good for the investment bank because they'll get nice commission before they pass it on to the investors. And investors are happy because otherwise they could not invest into these home loans, but now they're able to get an exposure to the home loans. This is how this entire system works, and this is what we call as securitization. I'll stop here, but ask me questions and be very, very clear with the logic. What each and every person is doing why that person is doing it, how will that person make a profit, and so on. You cannot put a gun to somebody's head and say like you must do it. Everybody's doing it for a purpose.
So then basically they are pooling the assets of, and turning them for the tradable instrument. They are making the tradable instrument.
Yeah, like I wouldn't call it tradable because it's not like traded on the exchange and all, but yeah, like a bit more liquid. And they're just like adding kind of a value at each and every place. HDFC Bank added a value in terms of finding a customer. Sorry, broker added a value in terms of finding a customer. HDFC Bank added a value by giving a loan and doing all the paperwork. Investment bank added a value in terms of dividing them into three heaps. So that's the reason all these three parties gets a nice commission.
But sir, like what I'm confused about is like for a bank, they majorly earn from their interest.
Very good
And
point.
yeah, and if I see here, like let's say if like the deal is cracked at 1020, the bank is just earning 2% like today itself. And
Right.
even if like I consider time value for all these loans, it will be much higher than 20 crores.
Okay, that's a very good question, right? Varun, ki matlab, one thing is like 2% bana rahe hain, versus they
Hmm.
could have made 2% every year.
Exactly.
The difference between the interest income, what they earn, versus the interest what they pay to the, let's say, the Central Bank of India, Reserve Bank of
Hmm.
India, right? So in this case, what happens is that many times, like the HDFC Bank may not do this again and again, but let's say they are falling short of funds, right? Do they want to lose their image in the market that we are just not sanctioning the home loans? Do you want to come into the market and say, hey, we don't have money? Or even if they have money, but they have a internal requirement, right? Like we don't want to give that money for a home loan. We want to have an exposure to other assets. We want to have an exposure to the commercial loans or an auto loan. So in those cases, I'm ready to sell my basket to somebody else. And don't you think HDFC Bank will be more than happy when they have a bigger market share within home loans? So
Hmm.
let's say my total balance sheet or the total loans I can give is 5,000 crore rupees. And with this 5,000 crore rupees, I can capture 30% market share.
Hmm.
But by selling these parcels to somebody else, what I'll do is I'll create maybe 9,000 crore rupees ka loans. I'll keep 5,000 with myself. I'll sell remaining 4,000 to the investors. तो जो मेरे को मेरे पास रखना वो तो रख रहा हूं मैं, जो एक्स्ट्रा एडिशनल है आई एम गोइंग टू सेल इट टू दीज इन्वेस्टर्स. So जो interest income है that's there. Over and above there's a 2% extra which I'm able to sell it to the investors. So it's not coming at the cost of interest income. I'll give an
Okay.
analogy, okay?
Hmm.
There was a relative of mine. The relative of mine said, yaar, ki I need money. Do you have money? Now, that's a very good relative of mine, doing very solid. I can trust that relative more than a bank. And that relative pays me, let's say, 12% interest. तो मैंने क्या किया, अपना जितना भी पैसा है मैंने उसको दे दिया 12%. But then I got an idea. I asked another friend of mine, hey, do you have money you want to lend me? तो उसने बोला यार मतलब if I go to a bank I get 6 to 7%. If you can give me 9%, I'm ready to give you this much money. I took that money from that friend and gave it to my friend, my relative. So I'm not losing out on my 12%. I'm
Hmm.
just earning interest spread on the other income as well.
Okay, sir.
So it's
Got it.
over and above.
Hmm. And like not related to like CFA, but like in general. So can we say like these investment banks which are investing are acting like bad banks in this case?
Why bad banks?
Because like what like it can happen that HDF like in the low quality hip they can give them some NPS of
Yeah,
their own.
yeah,
So like are they acting like bad banks in this case? Because it's like they are not giving like what I can say 1,000 crores worth of NPS, but like the percentage is quite less.
yeah. When you say NPS, non-performing
Yeah,
funds, right?
assets.
So in this case, see, these investors are not like you and me, right? Who are retail people or layman people who doesn't know the risk associated with it. They are hedge funds. They're large investors. They understand the risk. And the reason they are ready to buy this, yes, there could be lots of NPAs, but 15% return, man. You don't get that much return in the equity market.
Right.
So they've done their calculation. And guys, this is a huge market. I did it for a home loan. The same thing can be done for a car loan. The same thing can be done for other loans, which we'll discuss as we go further. So your 3 chapters, let me just give you a very broad overview. We are going to call mortgage as an asset. Is a loan for the borrower, but it's an asset for the lender. Okay? So in this case, this entire concept of securitization is discussed in reading number 65, fixed income securitization, what we discussed just now. We'll go through the pages, but this securitization can happen in the mortgage market, which is the home loan market. So we call it mortgage backed security, which is nothing but MBS, which is reading number 67. If you create a security out of any other asset, like a car loan, credit card, education loan, in that case, we don't call it MBS, we call it asset backed security, which is ABS. So if you change that home loan with a car loan, it'll become an ABS. So guys, all the 3 chapters are dependent on this concept. So I'll go back to the concept and feel free to ask any questions on the logic, why each party will get involved into these transactions. Cool. So what we'll do is we'll take a break, and after the break, I'll show you a nice video. We'll give you further clarity on how does it work, and you'll be able to relate with what we discussed. And the video will help you to understand what we're going to do next in these 3 chapters. Okay. So let's take a break. It's 10:41. We'll be back at 11 and then continue. Okay, so let's continue, guys. Let me know when you are back and switch on your cameras. Okay, so I'm going to play this video. But before that, like, let's come back and start your cameras. Arav, Arun, Varun, Yogesh, please switch on your cameras. So what we're going to do in this video is, like, first of all, it revisits everything we have discussed so far in a more graphical, pictorial manner. So it'll become a bit more interesting to listen to the similar thing, but in a video style, right? And the second thing is, it talks about what happened during the 2008 and 9 recession. It was a big recession. Every interview, every discussion you talk about, there's a very high chance there will be a mention of 2008 and 9 recession, right? So what exactly happened in 2008 and 9? And guys, 2008 and 9 का जो recession है, that was entirely MBS driven. It was driven by mortgage-backed securities. So as a result, you must see this video, not just for your CFA examination purpose, but also otherwise. Okay? So let's get started. I'll play the video. It's for 10 minutes. You can raise your hand in between if you want me to stop and you want to ask some questions. Otherwise, you can wait for the end of the video and we can discuss about it. Okay? Are you able to see the video and hear the audio as well?
No audio.
Not the audio.
Or not the audio? Okay, give me 1 second.
Involving terms you probably
Can you hear it now?
the crisis of credit visualized. What is the credit crisis? It's a worldwide financial fiasco involving terms you probably heard, like subprime mortgages, collateralized debt obligations, frozen credit markets, and credit default swaps. Who's affected? Everyone. How did it happen? Here's how. The credit crisis brings two groups of people together, homeowners and investors. Homeowners represent their mortgages, and investors represent their money. These mortgages represent houses, and this money represents large institutions like pension funds, insurance companies, sovereign funds, mutual funds, etc. These groups are brought together through the financial system, a bunch of
So guys, homeowners, like the first link in the entire chain who actually needs money, and investors are the last link in the chain who eventually invest the money, right? Everyone else is an intermediary.
banks and brokers commonly known as Wall Street. While it may not seem like it, these banks on Wall Street are closely connected to these houses on Main Street. To understand how, let's start at the beginning. Years ago, the investors are sitting on their pile of money, looking for a good investment to turn into more money. Traditionally, they go to the U.S. Federal Reserve, where they buy treasury bills, believed to be the safest investment. But In the wake of the dot-com bust in September 11th, Federal Reserve Chairman Alan Greenspan lowers interest rates to only 1% to keep the economy strong. 1% is a very low return on investment, so the investors say no thanks. On the flip side, this means banks on Wall Street can borrow from the Fed for only 1%. Add to that general surpluses from Japan, China, and the Middle East, and there's an abundance of cheap credit. This makes borrowing money easy for banks and causes them to go crazy with leverage. Leverage is borrowing money to amplify the outcome of a deal. Here's how it works. In a normal deal, someone with $10,000 buys a box for $10,000. He then sells it to someone else for $11,000. For a $1,000 profit, a good deal. But using leverage, someone with $10,000 would go borrow $990,000 more dollars, giving him $1 million in hand. Then he goes and buys 100 boxes with his $1 million and sells them to someone else for $1,100,000. Then he pays back his $990,000 plus $10,000 in interest. And after his initial $10,000, he's left with a $90,000 profit versus the other guy's $1,000. Leverage turns good deals into great deals. This is a major way banks make their money. So Wall Street takes out a ton of credit, makes great deals, and grows tremendously rich, and then pays it back. The investors see this and want a piece of the action, and this gives Wall Street an idea. They can connect the investors to the homeowners through mortgages. Here's how it works. A family wants a house, so they save for a down payment and contact a mortgage broker. The mortgage broker connects the family to a lender who gives them a mortgage. The broker makes a nice commission. The family buys a house and becomes homeowners. This is great for them because housing prices have been rising practically forever. Everything works out nicely. One day, the lender gets a call from an investment banker who wants to buy the mortgage. The lender sells it to him for a very nice fee. The investment banker then borrows millions of dollars and buys thousands more mortgages and puts them into a nice little box. This means that every month he gets the payments from the homeowners of all the mortgages in the box. Then he sicks his banker wizards on it to work their financial magic, which is basically cutting it into 3 slices: safe, okay, and risky. They pack the slices back up in the box and call it a collateralized debt obligation, or CDO. A CDO works like 3 cascading trays. As money comes in, the top tray fills first, then spills over into the middle, and whatever is left into the bottom. The money comes from homeowners paying off their mortgages. If some owners don't pay and default on their mortgage, less money comes in and the bottom tray may not get filled. This makes the bottom tray riskier and the top tray safer. To compensate for the higher risk, the bottom tray receives a higher rate of return, while the top receives a lower, but still nice return. To make the top even safer, banks will insure it for a small fee called a credit default swap. The banks do all of this work so that credit rating agencies will stamp the top slice.
So guys, sorry, in this case, what will happen is that the top heap, the best quality heap, where the chance of default are very, very less, to make it risk-free, some banks will say, okay, even if the homeowners default, we are ready to pay you and compensate for that. To give you that guarantee, they'll charge you 1% commission. So your 4% becomes 3%, but 4% was with a lower risk, 3% is with a 0 risk. That's the main difference. Okay. So now investors have an option to invest into federal government bonds giving 1% return, or invest into this top quality slice guaranteed by banks giving you 3%. Both of them are risk free, but here you're getting 3% rather than 1%.
Is a safe AAA rated investment, the highest, safest rating there is. The OK slice is BBB, still pretty good, and they don't bother to rate the risky slice. Because of the AAA rating, the investment banker can sell the safe slice to the investors who only want safe investments. He sells the OK slice to other bankers, and the risky slices to hedge funds and other risk takers. The investment banker makes millions. He then repays his loans. Finally, the investors have found a good investment for their money, much better than the 1% Treasury bills. They're so pleased they want more CDO slices. So the investment banker calls up the lender, wanting more mortgages. The lender calls up the broker for more homeowners, but the broker can't find anyone. Everyone that qualifies for a mortgage already has one, but they have an idea. When homeowners default on their mortgage, the lender gets the house, and houses are always increasing in value. Since they're covered if the homeowners default, lenders can start adding risk to new mortgages, not requiring down payments, no proof of income, no documents at all. And that's exactly what they did. So instead of lending to responsible homeowners, called prime mortgages, they started to get some that were, well, less responsible. These are subprime mortgages. This is the turning point. So, just like always, the mortgage broker connects the family with a lender and a mortgage, making his commission. The family buys a big house. The lender sells the mortgage to the investment banker, who turns it into a CDO and sells slices to the investors and others. This actually works out nicely for everyone and makes them all rich. No one was worried because as soon as they sold the mortgage to the next guy, it was his problem. If the homeowners were to default, they didn't care. They were selling off their risk to the next guy and making millions, like playing hot potato with a time bomb. Not surprisingly, the homeowners default on their mortgage, which at this moment is owned by the banker. This means he forecloses and one of his monthly payments turns into a house. No big deal. He puts it up for sale. But more and more of his monthly payments turn into houses. Now there are so many houses for sale on the market, creating more supply than there is demand, and housing prices aren't rising anymore. In fact, they plummet. This creates an interesting problem for homeowners still paying their mortgages. As all the houses in their neighborhood go up for sale, the value of their house goes down, and they start to wonder why they're paying back their $300,000 mortgage when the house is now worth only $90,000. They decide that it doesn't make sense to continue paying, even though they can afford to, and they walk away from their house. Default rates sweep the country, and prices plummet. Now the investment banker is basically holding a box full of worthless houses. He calls up his buddy, the investor, to sell his CDO, but the investor isn't stupid and says, no thanks. He knows that the stream of money isn't even a dribble anymore. The banker tries to sell to everyone, but nobody wants to buy his bomb. He's freaking out because he borrowed millions, sometimes billions of dollars to buy this bomb, and he can't pay it back. Whatever he tries, he can't get rid of it. But he's not the only one. The investors have already bought thousands of these bombs. The lender calls up trying to sell his mortgage, but the banker won't buy it, and the broker is out of work. The whole financial system is frozen, and things get dark. Everybody starts going bankrupt. But that's not all. the investor calls up the homeowner and tells him that his investments are worthless. And you can begin to see how the crisis flows in a cycle. Welcome to the crisis of credit.
Guys, could you relate some of it with the example or with the entire work we are doing? And this is actually what happened in 2008, 2009. That these banks, these investors were giving loan to anybody and everybody. And the main fundamental assumption was that the value of the houses will keep going up. And that was like the black swan event, that it never happened in the past, that the housing prices have gone down. And this was the first time ever that the housing prices went down, and everybody was caught with a surprise. And the surprise was so big that it became a global recession. So we have seen like lots of recession and the financial crisis, but 2008 and 2009 crisis, which is based on the mortgage-backed security, has made its name on the top board, and it's called Great Financial Crisis. It's greatest of all. Because during this time, like some of the banks went bankrupt. You must have heard about the names of like Lehman Brothers, Stearns, and Freddie and Fannie Mae. Like many banks went bankrupt, and other banks, went down by like 90%, 95%, 97%. So that time, like the suicidal rates in Wall Street, anybody who's into investment banking were at the all-time high, because people were expecting the portfolio will become double, but they lost everything they have earned in the last 15, 20 years. Okay, so you must read up more about it, like what happened during Great Financial Crisis, but you know the starting point now, what triggered everything. And we discussed about Black Swan in the past, right? Like what is Black Swan event? How does it impact and all of it? Sorry, I think my internet connection is not proper. Let me just change out to another one. Give me 1 second. Was there some quality issue on the video as well? Because I think I was connected to the one internet which was not proper, but now shifted to another one. Is it better now? Or is equally bad, or
It's better.
this is better now, right? But did you face difficulty? Like when I was playing video, I didn't realize it. Sorry.
No, no.
It was fine. Okay. So where were we? Yeah, like we discussed about Black Swan event, right? In one of the previous classes. What is Black Swan event? What is Black Swan? No? Yes or no, guys? Can you put that in the chat window? Whether we have discussed it already, then I'll just like let it go. Otherwise, I want to chat more about that Black Swan as a concept. Again, not very relevant for your CFA curriculum, but every time we talked about like financial markets, Black Swan as a terminology come up very, very often. So my question is, have you discussed about it already? A reminder for everyone to please switch on your camera. Himanshri with their cameras on. Okay, so let me discuss it again. So what is the Black Swan event? Any idea? Have you heard about it? What do you mean when I say a Black Swan event? I use the word Black Swan event for 2008 and 9. What is the Black Swan event? That the housing prices went down for the first time ever. So there's a book, by the way, called Black Swan. It's a super book. You must read it if you get time. So the focus is on what is Black Swan. Anyone in this room?
Like the 2007 and it comes to under surprise events. So whatever happens under surprise and it gives a major impact on the whole particular situations or the whole world.
Okay, surprise. Okay, so some of my friends from college, not like this year, but last year, came to my house for my birthday celebration. All of a sudden, it was a big surprise. Is it a Black Swan event?
Yes, sir.
Like, and it's like some event that has never happened in the history, but that has happened like that on that specific year. Similar.
So if nobody knows about the concept of a surprise birthday party, and the first person who got it the first time ever, think about the surprise factor for that person who has never heard about it. कि अच्छा ऐसा भी कुछ होता है. And some friends went to her or his house on her or his birthday, and nobody has talked about it ever, nobody has done it ever, nobody has seen it ever, and this happens for the first time ever with somebody, then I'll call it a Black Swan event. In my case, it happened for the first time for me, but I knew, like, these kind of things happen, right? So Black Swan is something which has never happened. People have not thought about it, people have not considered, people have never seen it, experienced it, either themselves, sorry, and nobody else they've heard experiencing the same thing. Is a Black Swan event. So yes, housing prices going down was a Black Swan event in 2008, because nobody has ever seen it ever before. Another Black Swan event would be COVID-19. Did you expect it to happen in 2019? No. Did somebody seen it before? Maybe not. When it again happened in 2021, that was not a Black Swan event. But COVID-19 का जो पहला wave है, that was a Black Swan event. So guys, Black Swan event, the probability of that happening is very, very less. And these are the Black Swan events which kills the economy. क्यों लोगों को लगता है ऐसा हो ही नहीं सकता, and when it happens, everybody is caught with a big shock. The last two recession, 2008 and 9 recession, was driven by a Black Swan event, which is the decrease in the housing prices, which has never happened in the past. And the second Black Swan event was the COVID-19. And that has not just changed the market, but has changed the entire lifestyle of people. Like if you look at the demographic things, like how people are consuming more than what they were consuming before. So there's a study which has been done. So if a typical person with a salary of, let's say, 100 rupees, prior to COVID-19 was spending 30, 40, 50 rupees and saving a majority amount of it. After COVID-19, that trend has changed. The same person with a similar salary is now spending 60, 70 and saving only 30, 40. So लोगों को पूरा, like the mindset has changed now. Though the COVID-19 is gone for all practical purpose, but people mindset has changed forever. And if you experience a similar thing like pre-COVID versus post-COVID, your consumption behavior has changed. Like you're consuming more rather than consuming less, or it has not changed at all. Lots of introverts in this room.
Consumption pattern has already like eventually changed. Like
Can you give some example like how it has changed?
maybe like like what I have seen in my family, they are investing more on health insurance and like getting better health insurance with more coverage kind of thing. So that is one that
Area
has
of expenditure which has increased quite a lot. In the
well,
food habits, like you eating more healthy than what you were eating before. The entire focus on the health side has increased.
Hmm.
पहले मैं ingredients देखता ही नहीं था, मतलब. But now, even if I look at the ingredients for Kellogg's and the muesli and all, I see it and then eat it. I was eating this, some Britannia ka 5-grain biscuit, which are digestive biscuits. मुझे पता चला it's more sugar than digestive. So, that way things have changed a lot. But उसके अलावा भी, like this is like practical part of it. But the amount of money people are spending on travel. मतलब you should see the flight tickets. Oh my God. So my wife and my kids went to Rajasthan from Bangalore. The per person one-way ticket was 10,000 rupees. And another family in the same apartment, in my apartment, went to Singapore and came back. The return tickets were 13,000 rupees. I was telling my wife, rather than going to Rajasthan, you would have gone to Singapore and would have saved money. So, these things are happening, guys. And look at the hotel cost. Like, a 3-star hotel or a 4-star hotel is costing so much more these days. लोग बोलते इन्फ्लेशन है, अरे क्या इन्फ्लेशन काम आएगा? If people are not ready to pay, the hotels will be empty and they won't have a choice but to reduce the cost. But they are getting people. They don't have to reduce their rentals. So we had a plan, like we were in Pondicherry for some work and we thought, we'll stay in a nice property. वहाँ पे एक property है. This is called Taj Ka, I forgot the name. Fisherman Cove. Nice, beautiful property right on the beach side. And हमें लगा, I always wanted to stay in that property. So I thought we'll stay in the property and we'll take a nice cottage room. मेरा expectation था I'll get a nice cottage room for 12,000-13,000 rupees. And then I called the hotel and they said like it's 33,000 rupees. We changed the plan. So see, in this case, if there's a black swan event, it takes everyone with a surprise and the impact on the economy is quite significant. The good thing about black swan event is that people get ready for it. That if similar event happens again, people do not get that much shocked. But the problem is that people have a short-term memory. So after 2008 and 9, people said that this kind of crisis can never happen because banks have learned their lesson and now they'll be very, very careful in terms of who they lend the money to. They will not lend money to the subprime people. Subprime people means their credit quality is not that great. But you know what? In 2021 and 22, there was another recession which was in the form of becoming, but it never happened. But some of the US banks failed already. But thank God, the regulators became a bit more serious and not all the banks were involved into it. So it did not grow up to the extent of 2008 and 9. So there's a possibility of a black swan event happening again and again as well because people have a short-term loss. Okay? So in this case, this black swan event, which is 2008 and 9, was driven by mortgage-backed security. Next time हो सकता है ये किसी और से driven होगा, but given the impact on the economy, it has become a nice 2 or 3 chapters in your fixed income book. ये chapter पहले भी थे, but the way these chapters have been discussed, the way these chapters have been described, they have put more meat around it, given the significance of these chapters. ठीक है? So with that context, guys, let's go through it. बहुत टेक्निकल लगेगा तुम्हें हर चीज, बहुत थियोरेटिकल लगेगा, but with the background we have discussed, with the basics we have discussed, I hope things will be a bit more interesting than what is there in your content. ठीक है? Any question before we go through it?
Ansh, one question. We discussed about the package being sold by the banks to the investment banks, right? So
Yeah.
my first question, so once this package is sold off to the investment banks, it goes off the balance sheet of the first bank, right? The lenders. If so, the debt service which is happening from the retail consumers, I mean the homeowners, that will be collected by the original banks as the collection agents, and they will be transferring it to investment banks. And in case there is any credit risk or a default is happening, whether the investment banks will be neutralizing that particular dip to the last investors, or the investors will suffer that much dip in the credit payments, interest payments.
Okay. So yes, you use the word very correctly, collection agent. So once the lender, the HDFC Bank, has sold its parcel to Goldman Sachs, for all practical purpose, the agreement is still between the homeowner and HDFC Bank. HDFC Bank will simply collect the money and pass it on to Goldman Sachs. So HDFC Bank has no right on that particular mortgage. They're simply the collection agent on behalf of Goldman Sachs. If Goldman Sachs has sold that parcel already to the investors, and if the homeowner defaults, that's neither a loss to HDFC Bank nor a loss to Goldman Sachs, is directly a loss to the investor. But see, everything is work in progress. There could be some parcel which are not being sold by the investment bank to the investors. So on that parcel, it's a loss for the investment bank. There could be some parcels which are still with HDFC Bank and not being sold to Goldman Sachs. So on that parcel, it's a loss to the HDFC Bank. So there was a word being used in that video. It's like playing a hot potato game. अपन नहीं खेलते म्यूजिकल राउंड के साथ, wherever music stops, जिसके पास भी वो hot potato है gets out of the game. So it was a hot potato with a bomb called mortgage-backed security. तो जिसके पास है उसका loss है. If you pass it on to the next person, it's the next person's loss.
And how is this issue to the final investors? We talked about bonds and also if it is like a full face value or zero coupon bond, how will be traded to those folks?
Oh, that's a very nice question. तो इसके अंदर you can make many products out of it. तो उसके अंदर मतलब I don't know like how much is covered in level 1. I'll just go through your. So
No,
it'll
it's
be
fine.
covered in
I
your
was
level
just
67.
asking.
हाँ, तो it can be very nice. अलग-अलग तरीके से कर सकते हो, right? So think about that lychee vendor. One heap, like within high quality, one heap could be like the red and the plumpy ones. Other could be, like one with no stains. So in this case, one, like what the investment bank can do is, okay, whatever principal comes first, I'll give you the principal. These are called principal only tranches. एक होता है first come first serve. जो भी पहला पैसा आएगा मैं तुम्हें दे दूंगा, जो लास्ट में पैसा आएगा will go to the last tranche. So there are many ways, guys. Let me check how much is covered in level 1, because there's a lot more detail when you get into level 2 on those front.
And one more thing in this whole game of players, what is the benefit that the investment bank is getting? See, he has to pay the premium to the bank. He has to pass on the interest received to the investors. What is the cushion or the attractiveness point of view for the investment bank, apart from getting a pie of whole set of market product, which is unless not reachable to them?
So I got it from the HDFC Bank for 1,020 crore rupees.
Yeah.
And when I securitize it and sell it to the investors, I get 400 plus 300 plus 350, which is 1,050 crore rupees.
All right. So this is the amount that the investors will pay, just like okay, that
Yeah.
clarifies.
Yeah. So see, I don't know whether 1,000 will become 1,020 or 1,100. I have no idea about it. Whether this 1,020 will become 1,050 or 1,200, I have no idea about it. But yeah, like at each and every stage, all these three people are making nice commission. The commission can be 1 or 2%, but when you take 1 or 2% of billions of dollars, the commission itself is millions of dollars. So I'll show you one chart again. They'll give you a very nice idea. Citibank was big in mortgage-backed security, by the way. This is the chart. So Citibank is a very old bank. 1986 the price was $19, $20, $30. People were very happy. Wow, like the kind of gold run they had. There was a small recession in 2000, 2001, which was like driven by tech. But it was a very like 30-40% dip, and the markets recovered very, very fast. And see here, before 2008 and 9 crisis, Citibank was around 530, 525. After crisis, within like a year, it fell down to 25. And guys, 25 nahi, it went up to 15 and 16 rupees. So the decline, if you calculate, is a 97, 98% decline. You know what? Some of the bank management, Citibank management says, following the financial crisis in 2008 and 9, our share prices have become 4 times. Yes, 15 has become 60. But think about somebody investing money here. They're still sitting on a loss of 95%, 92%. This is what the financial crisis did for a bank like Citibank, who had a huge exposure to mortgage-backed securities. And you compare this with any other company which is not that much impacted. Let's take Walmart. Try to figure out where's the recession impact on this chart. वो तो global recession था, right? Oh, there's a recession impact, guys. You have to be very, very careful. See, यहाँ पे peak था, यहाँ पे there was a decline. You see? But guys, on a bigger scheme of things, you can't even see the decline because these companies were less impacted by that financial crisis. So it's not like the entire market went down. Some of the securities, some of the companies who are more exposed to MBS went down. And why Citibank? Like, I don't know whether we'll get the chart for Lehman Brothers anymore. No, we don't get it for the unlisted securities, but it went down to 0% technically, right? That's the reason they become bankrupt. But even if you look at Deutsche Bank, I think even they were impacted a lot, but not to the extent of Citibank, I think.
So Northern Rock as well.
Also dropped from 90 to 16.
Yeah. Here they went down from 90 to 16, or not that much. They fell down only by 80% rather than 95%. But see the problem, like they've not been able to recover to that level, and Deutsche Bank has become even more problematic in the recent years. So some people who invested the money here, think about it. 20 years down the line, they're still on a loss of 70, 80%. Okay, so we'll start with fixed income securitization. We'll get into ABS, but we'll spend lots of time on MBS. So let's do it now. We have got all the background stuff done. A bank making loan is called originator. In our example, that's HDFC Bank. The pool of asset is sold to a separate legal entity. So what HDFC Bank will do is, before passing it on to somebody else, they just create a special purpose entity. It's a legal thing. It doesn't change the thing which we discussed at all. Securitization connects the owners of capital, which is the investors, the investors with the investment bank, with those that require capital, the borrowers, which is the homeowners. How does it help the originator bank? How does it help HDFC Bank? Increased business activity. Rather than giving 1,000 loans of 1 crore rupees each, they can give 3,000 loans of 1 crore rupees each. Because they make a basket, they sell it to investment bank, they get the money. Again, use that money to again make a basket and sell it to the investment bank. Improved profitability. Every time they sell a basket, they get a nice commission out of it. Lower capital reserve for banks. Rakesh, you used a word that once I sell the parcel to another bank, it's off my balance sheet. So I don't have to keep a reserve for that amount of loan because it's not my loan anymore. It's somebody else's loan. So there's a requirement from the central government, sorry, Reserve Bank of India, central bank, to keep some amount as safety in case your customers default. But once you give the loan to somebody else, that's not your problem anymore. And the improved liquidity, you get more funds in your pocket. What are the benefits for the investors? Tailored risk and return. Investment bank will divide into different heaps, right? High quality, low quality. So different investors can invest depending on their requirement. Access, that's the most important part. The investment banks don't have access to the retail things like, car loan, home loan. But by getting into the securitization, they can provide their investors, their clients, with the investment into these assets. And the liquidity is same. What are the benefits to the economy? Overall, there's a decreased liquidity risk because everybody has got more money now. Improved market efficiency. What is the market efficiency, guys? If I want something, if there's a buyer and seller for it, it's good for everyone. So for example, I was just thinking about this application called Quick Ride. Have you used this application? Have you heard about it? Quick Ride? इसमें क्या होता है कि let's say if somebody is going to office in her or his own car, you can see it on the application, and if that person wants to offer a ride, you can take the ride with that person. So if Uber is charging 20 rupees per kilometer, on that application you have to just pay 4 rupees, 5 rupees, 6 rupees per kilometer. Uber driver can throw attitude and tantrums and be rude. These people will be very, very nice. You can have a nice discussion. It's good for me if I want to take a ride. Yes, I save 75-80% of my cost. Is it good for the person who is giving the ride? Yes, it's pretty good because they get some money and they get some company as well, rather than being stuck in the traffic alone. So in this case, doesn't it improve the efficiency? Isn't it good for the person who is providing the service? Isn't it good for me who is taking the service? And isn't it good for the Quick Ride as a company who is making revenue out of it? So as a result, whenever you create a market out of anything, it's good for everyone. It increases the market efficiency. So in this case, the investment banks and the investors will never get access to the home loan market. But because of securitization, these investors are able to invest and the homeowners are able to get more money from the banks. So it's good for the overall economy. Lower financing cost. If these banks, HDFC Bank, were not able to sell this package to the investment bank, they would have to borrow money from somebody else, and that would have been a costly affair. And lower leverage for originators, as I told you, because they're able to sell it. They do not have to keep the reserves and resources as per the Reserve Bank of India. So guys, in nutshell, it's good for the customer, it's good for the investors, it's good for the bank, it's good for the investment bank. It's good for everyone. Oh, see, they couldn't complete this topic without talking about 2007, 2009. It must be talked. Otherwise, this topic is incomplete. Okay, so they've just given some example, like in a similar way we did it. Like how does it happen? How does it created? You can read through it. Now, if you do this securitization based on car loan, credit card, mobile phone loan, then we call it asset-backed securities. So in this case, I won't get too much into theory, but let's say if I want to take a loan, but nobody is ready to trust me with their money. So what I do is I do a over collateralization. So guys, gold loan, you get a rate of interest which is lower than the personal loan. क्यों? क्योंकि उसके अंदर you're giving a collateral. And if you are ready to give a lot of collateral, I give you an example, right? If I'm ready to give a collateral worth 5 crore rupees for a loan worth 1 crore rupees, the rate of interest will be very, very less because then the lender does not have to bother about my capacity and character. So in this case, if you want to reduce your credit, sorry, if you want to increase your credit worthiness, what you can do is you can go for an over collateralization. In this case, if you go for over collateralization, it means for a loan worth 1 crore rupees, the mortgage or the security you're putting in the form of an asset is lot more than 1 crore rupees. Excess spread, credit tranching, these are fine. I won't spend too much time. Waterfall. Video में तुमने देखा था, right? कि first of all, the payments will go to a senior tranche, like the safer investors. If some money is left, that will go to the medium tranche. If some money is left, that will go to the risky tranche. Obviously, the safer tranche will get more lower return, and the risky tranche will get a higher return. Because the risk they are taking is a lot more. Okay. Now the point is, before we get into further work, this entire structure from end to end, how many days do you think it'll take you to get the home loan from a bank and get it sanctioned and approved? So think about a broker finding a customer who wants a home loan, broker and the homeowner having a meeting, homeowner applying for a loan from the broker taking the paper to the HDFC bank, HDFC bank reviewing the file, giving the loan, approving the loan, disbursing the loan. How long the process will take, roughly?
20 to 30 days.
ये बोलते हैं, but it takes like 2 months, right? Sorry, I see a comment from Yogesh. We have blah blah in Mumbai, Pune. What is it about? Oh yeah, अच्छा, the cab जैसे quick ride की जगह जैसे blah blah भी है, right? You're right. I've heard about it, Yogesh. ठीक है. Once HDFC Bank, वो बोलते 20-30 दिन है, but it'll take like maybe more than 20-30 days. It'll take like maybe 2 months. Then HDFC Bank has to sell the basket to investment bank. That'll take another 1 month. Investment bank will have to sell the basket to the investors. They'll take another 1 or 2 months. So the entire cycle will take almost 6 months. Does it make sense in case of a home loan that once you complete the cycle for 6 months, the home loans generally, what is the tenure for a home loan?
20-30 years.
20 years. But generally there's a thing in the market that though the tenure is 20 years, but generally people repay the money in advance and the money will be paid in 12, 13, 14 years. And I'm sure that it would have been the experience with you guys if any of you have taken a loan. Though you take a 20-year loan, you repay it ahead of the time. Why ahead of the time? Because EMI remains the same, but your earning power increases. So this is another benefit to the bank. When they give you a loan, they look at the capacity in 2024. But by the time you get into 2034, 10 years later, your earning capacity is a lot more, but they're still charging you higher rate of interest. So character doesn't change, let's assume, but your capacity improves, your collateral improves, but still they charge you the same rate of interest. Now, in this case, even if it takes 12 to 13 years for you to complete your home loan, it makes sense for HDFC Bank. It makes sense for the investment bank. It makes sense for the investors to spend that 5 to 6 months to complete the cycle, so that once they complete the cycle, they can sit back and enjoy it for the next 11, 12 remaining years. So the effort that has been put is worth it. Why it's worth it? Because then they will be invested for the next 10 to 12 years. Car loan में कितना होता है? What is the tenure for a car loan?
5 to 6 years, sir.
5, 6 years. 7 years max. 7 years. But see, in this case also for a car loan, the entire cycle will take 3 to 4 months to complete. But once you complete the cycle, you can invest your money for next few years. May not be 10 to 12 years, but still 3 to 4 years. Makes sense. Now, what if I tell you that you can do the same thing with your credit card? It means that if a bank has given you a loan, sorry, not a loan, a credit card, you use that credit card. So let's say I use this credit card for 70,000 rupees this month. Not only me, there are so many other people who have got the credit card from the same bank. The bank has given the credit card to, let's say, 10 crore people. And if you do the math, let's say the total 700,000 crore rupees or 700 lakh rupees, whatever, some money has been used by people, right? In how many months do you repay the credit card bill? What is the tenure for that?
One month, like a little
40
bit
days.
later. Yeah.
30 days, 35 days, 40 days. Does it make sense to complete the entire cycle for a credit card bill? कि जब तक तुम साइकिल कंप्लीट करोगे पैसे ही आ जाएगा तुम्हारा वापस. You get that point? So guys, the first thing I see in this chapter is credit card ABS, an asset-backed security which is backed by not a home loan, not by a car loan, but backed by credit card. Isn't it very counterintuitive? So in this case, take any of your credit card, there's an expiry date. So in this case, what will happen is this bank, which is giving a loan to, let's say, 10 crore people, the credit card limit is, let's say, 1 lakh rupees for each of these credit cards. And this credit card was issued by a bank, let's say, in June 2024, with the expiry of June 2029. What HDFC Bank will do is they know from their prior experience that out of 1 lakh rupees, some people will consume entire 1 lakh rupees, some people will consume only 10,000 rupees, some people won't use a credit card at all. So they know that on an average, people use 70,000 rupees on credit card. We have given 10 crore credit cards. So the total amount which will be given to these customers in the form of credit will be equal to 700 lakh crore rupees. Now, what the bank will do is they will sell the entire portfolio of credit cards to the investment bank. Investment bank will sell it to the investors. But the understanding here is that whenever these people pay the money to HDFC Bank, HDFC Bank won't transfer it to the investment bank. In case of a car loan, in case of a home loan, every time I get a payment from the homeowners or the car owners, I pass on that payment to the investment bank. We call it pass-through securities. But in case of credit card, whatever payment I get from the customer for the prior month, HDFC Bank will keep that money and use that money to give them the credit for the next month. Again, they'll make the payment. Again, HDFC Bank will not pass on the money to the investors. They'll use that money to repay to the credit card holders for the next month. And this cycle will go on for the next 5 years till the expiry of that particular lot of the credit cards. And when I get it for the 60th month, whatever payment I get, I go and give it to the investment bank, and the investment bank will give it to the investors. So in this case, Rakesh, one of your questions was, this is an example where the investment banks and the investors are investing the money today, but they'll get the money only after 5 years. And it's kind of a zero coupon bond or a zero coupon investment from the investor's perspective. So this is not a pass-through security because the payments from the credit card holders to the bank are not being passed on to the investment bank, and the investment bank doesn't pass on anything to the investors. The cycle will repeat between the customers and the bank till the expiry of the card, which is 5 years. And after 5 years, all the payments will be given to the investment bank, and the investment bank will give it to the investors. Is that logical now? That it's sensible to spend that couple of months and a few $1 million to complete the cycle, because now you're going to get return for the next 5 years. So what will be the typical case? HDFC Bank, let's say, has given a loan worth 700 lakh crore rupees on these credit cards. They'll sell the basket to the investment bank for, let's say, 715 crore rupees. And they have sold the basket to the investors for 735 crore rupees. Now, because these customers will default, there will be some EMI charges, there will be some penalties, there will be some interest costs and all of it. At the end of 5 years, the total portfolio value of 700 lakh crore rupees will become, let's say, 800 crore rupees. So the entire 800 crore rupees will be passed on to the investment bank, and that will be passed on to the investors. So they're not getting any annual return or monthly return. They're getting a lump sum amount at the end of 5 years. Now, many of you will be thinking, यार कि इसमें फायदा कहाँ पे होता है credit cards के अंदर? Do you have any idea how the credit card companies make money?
Sir, by charging higher interest rate and get commission from companies.
But okay, how many times have you paid interest to your from your credit card bill, Ansh?
Sir, it doesn't own any credit card.
No. So see, don't think about yourself, guys. We are like more disciplined, smart, rational people, right? How many times you delay your payment? Have you defaulted on your credit card bill?
Never.
Or never say never. But yeah, like rare. अच्छा, by the way, guys, have you noticed कि credit card bill ऐसे अगर 20,000 rupees होता है तुम्हारा, there's a minimum amount you have to pay, which is 1,000 rupees, 5% of the credit card bill. Do you bother about it? Do you pay 20,000 or the minimum amount?
Full amount.
हाँ, क्योंकि अगर 1,000 rupees पे करोगे, which is the minimum amount, तुम्हें penalty नहीं लगेगा. But on the remaining 19,000 rupees, they'll charge you 3% per annum, with 36%. So even I think, यार, it's a like very nice thing कि I never paid a fees, I never paid a penalty. I'll pay the credit card bill on time. और ऊपर से मुझे benefit भी मिलता है सब कुछ. But think it from the credit card company perspective. जो भी तुम्हें benefit मिलता है, most of the time that benefit they'll get from the vendor. Majority of the time. तो अगर वो तुम्हें 2% points दे रहा है या कुछ कर रहा है, like they'll get that money back from the vendors, because through that credit card you're generating that business for the vendor. But if out of 100 people, if 2 or 3 people default on the payment, it's worth it for them. The amount of fees they're going to charge, amount of money they're going to charge is going to be crazy. The words cannot define it. The best way to do it is just default on one of your payments, and you'll see the financial and the mental and the entire trauma around it. 10,000 रुपया डिफॉल्ट करके देखो, 5,000 रुपया का फाइन आ जाएगा तुम्हारे ऊपर. Right? So this is the business model. So the risk is more, but trust me, the returns will also be more. Okay? So in this case, what I'm talking is 800. It won't be 800 crore rupees. After 5 years, it will be close to 950 crore rupees or 1,000 crore rupees. So the investors are not getting any annual return, but their 700 crore rupees will become 1,000 crore rupees in next 5 years. So we try to calculate the implied return every year. They're getting a decent return on a yearly basis. So guys, this is what we call as credit card ABS. The credit card receivable backed securities are ABS backed by pools of credit card debt owed to banks, retailers, travel and entertainment agencies. See here, the cash flow to a pool of credit card receivable includes financial charges. So if HDFC Bank gets any financial charges, they will also be passed on to the investment bank, and the investment bank will pass it on to the investors. It's a revolving period or a lockout period. It means HDFC Bank will not pass on the receipts from the customers on a monthly basis to the investors and the investment banks. It's a revolving credit. So the investors who invest into this ABS, there's a lockout period of 5 years, and after 5 years, they'll get the money back. Now, this is a very, very risky thing. Why? Because let's say the investment bank invested into this basket of 700 lakh crore rupees. अब इस 700 lakh crore के अंदर क्या है कि this month, Varun swiped his credit card only for 20,000 rupees. But let's say next month he'll swipe his credit card for 1 lakh rupees. So the mix of customers will keep changing. The amount can keep changing. As a result, the quality of that mix will keep changing. So that is an additional risk for the investment bank. But given the pool is so much, so big, that even if some customers change, the quality doesn't change quite a lot. Once the lockout period ends, which is after 5 years, the amortization period begins. It means whatever money I'll get from the credit card holders as an HDFC bank, I'll pass on that money to the investment bank, and the investment bank will pass it on to the investor. Oh, solar ABS. It was never part of your syllabus a few years back, but when everybody's talking about environmental, solar ABS bhi banne lag gaye. And guys, this is reality. It's not like they're talking theoretical. Just like they are credit card ABS, they are solar ABS. These are to install the solar panels for your residential or the official purpose. You can take that loan, and the bank can, that's a separate category of a loan. There's a car loan, there's a home loan. There's a loan for the solar panels. And that loan can be securitized. Now, anybody who wants to invest into ESG, see the word ESG, this is a nice category to invest into. So if somebody is excited about, yeah, solar is going to be a big thing, yes, you must invest into solar ABS. CDO, collateralized debt obligation, we already talked about, just dividing that into multiple heaps so that you can meet the risk and return requirement of different investors. So that was ABS, guys. But trust me, there are a lot more ABS than what is discussed. यहाँ पे खाली credit card और solar ABS की बात हुई है. But there's an ABS for auto loan. There's an ABS for education loan. There's an ABS for personal loan. There could be all the ABS. जितने भी loan है, सबके लिए ABS है. But our favorite and the most important and the sweetheart of the entire world is mortgage-backed security, the MBS. So this is an ABS, but the asset here is not just a simple loan, is a mortgage. So we call it MBS. This is something we are going to spend a lot more time and we are going to do a lot more work. Okay. So as I told, like we'll spend majority of the time on MBS, and this is what we'll do for the next couple of hours we are left with. Any questions, any comments so far? Let me just see what all is covered in your level 1. This is a very important part, guys. Prepayment risk, extension risk, and the contraction risk. We'll spend like 15-20 minutes on this part alone. Within mortgage, the loan can be taken for a residential property versus a commercial property. So if it's a residential property, we call it RMBS, residential mortgage-backed security. If it's a commercial property, we call it CMBS, commercial mortgage-backed security. Why do we make a difference between residential and commercial? Because if residential hai, then in this case, one thing is the collateral, but when I'm looking at the capacity, I'm looking at the capacity of the borrower. But if it's a commercial mortgage-backed security, I'm looking at the capacity of the business for which that property has been used. In case of residential MBS or a residential loan, the reason I'm giving the loan because I think that the homeowner will be able to repay the money from her or his salary or whatever. But if I'm giving a loan for a factory or an agricultural land, my focus is on whether this business is good enough and whether this business will generate enough money so that I'll get my money back. Right? So it's a very important classification, whether it's RMBS or CMBS. If you buy a residential property, but your purpose is to give it on rent, will you call it RMBS or CMBS? It will be classified as CMBS because your purpose is commercial, even if the property is residential. And guys, we won't talk about the other case. Like I cannot make a case where you plan to go and sleep in the factory. So a commercial property can never be used for the residential purpose. but a residential property can be used for the commercial purpose. Okay, so let's take a break. We'll talk more about RMBS versus CMBS, and we'll talk about the prepayment risk, which is contraction risk, and the extension risk. Agency versus non-agency we'll talk about. This we already discussed about. This is exactly what I was talking about, that you combine all the mortgage, make a basket, and give it to the investors. This entire process is what we call as securitization. But we'll still again talk about it. CDO and CMO we discussed, but we'll talk more about it. Z tranche. Okay, it's quite important. So I think it'll take at least 90 minutes, guys. So be ready. Have a strong cup of coffee. Something interesting, but something technical as well once you come back from the break. It's 12:08. Let's be back at 12:20. Okay, guys, let's continue. Please switch on your camera once you're back. Thank you, Souvik. Waiting for others. Can I request all of you to please switch on your cameras? Still see half the people with their cameras off. Okay. Now, in this case, let's talk about two people, homeowners and the investors, two set of people. Now, let's assume that the homeowners have taken a loan of 20 years. And let's assume it's a fixed rate loan. India के अंदर most of the home loans are floating rate loans, but let's assume it's a fixed rate loan for 20 years and with an interest rate of 10%, just to keep it simple. And these investors have taken a home loan, like different investors have taken a different home loan. The total combined package is worth 1,000 crore rupees. तो अभी investors क्या सोच रहे हैं, अरे वाह, if I somehow get access to this parcel or this package, I will make 10% return on the next 1,000 crore. The investors will think that I'll make 10% return on this 1,000 crore rupees for the next 20 years. Agree? Now, this 10% is similar to the coupon rate, what we have discussed in case of fixed income. क्योंकि एक बार homeowner ने अपना loan चालू कर दिया, the homeowner has to pay 10% forever for the next 20 years. Now, in this case, guys, the individual is a borrower and the investor is a big company or a big client or a big institute. Bonds के अंदर उल्टा होता है. Company which is a borrower and the individuals are the investors. यहाँ पे individual is the borrower and the large companies are the investors. But it's similar to the coupon rate of 10%. Face value is 1,000 crore rupees. Tenure is 20 years. And just like the market rate in case of a bond, the market rate here can also change. So if this investor believes that the housing prices will go up, this will result into over collateralization. Technically, the risk associated with this loan will go down. It means the market rate will go down, but the investor will keep getting 10% return. If investor believes that the economy is going to do good, the capacity of these borrowers will improve. The risk associated with these loans will go down. The market rate will go down. And what happens when the market rate goes down? The value of this package will increase, right? So the reason the investors wants to buy this package is because either they're assuming there will be an improvement in the home prices, there's an improvement in the overall economy. So that way the market rates will go down and the investors will still make 10% for the next 20 years. But in short, when the investor buy this package, they are getting excited because they will be making 10% for the next 20 years on the entire 1,000 crore rupees. But before they get too excited, they are smart investors. They do not just get carried away by the terms and conditions, they know the reality as well. And the reality here is that if it's a 20-year loan, if you look at the history, typically a person pays that loan in 13 to 14 years. So what I'm saying is, though the tenure of the loan is 20 years, but generally people repay, or I'll say prepay, or the time people take is 14 years. So when the investors are investing into this package, should they be excited for next 20 years or only for 14 years?
14 years by the time.
Right? Because the reality is that generally the homeowners will prepay the loan and they'll close the loan within 14 years. Now the point is, let's say the coupon rate being 10%, the face value being 1,000 crore rupees, the tenure here, I'm not concerned about is 20 years. The tenure I'm concerned about here is 14 years. So this is what the investors are getting in a normal world. Now the fun starts and everything we have discussed in a fixed income will come into play here. It's kind of a callable bond. Sorry, let me think about it again. Yeah, it's a callable bond in the sense that if the homeowner wants, they can repay the home loan as per their discretion. So guys, generally in case of a home loan, there's no prepayment penalty. You can pay more ahead of the time. So who has the flexibility to pay the loan faster? The borrower? Can the bank say, no, this month you have to pay 10 times your EMI? No, they can't ask me. But if I want, I can make more payment to the bank. So when the borrower has an option to pay it back, what kind of a bond it is? Is it callable or puttable? What is a callable bond? When the borrower can pay it back. What is a puttable bond? When the investor can sell the bond and get the money back. So in this case, who has an option, the borrower or a lender? Borrower. So as a result, in this case, it's like a callable bond, where the borrower has an option to pay the money back. And when the borrower will pay the money back, depending on the market rate. If the market rate is 9%, as a homeowner, I've taken a loan at 10%, the market rate is now 9%. I'm thinking, yeah, I'm paying 10%, but if I go and take a loan today, I'll have to pay 9%. I'm paying 1% more. What do you think? Will I repay faster or will I repay slower? Faster. And I'm not talking about 20 years becoming 14 years. 20 years will become 14 years irrespective of the change in market rate. I'm saying 14 will become 12 or 14 will become 11. Do you agree with this? Because still I have to pay 10% when the actual market is 9%. So in this case, the investor will pay faster. Sorry, the borrower will repay faster. Now, when the borrower will repay faster, what the investor will do with this money? The investor will take this money and invest it somewhere else. Investor को पहले क्या लगा कि I'll get 10% return for the next 14 years. But rather than 14 years, I'm repaying the money only in how many years? 11 years. And is the investor able to reinvest this money at 10%? No. The investor will be able to reinvest this money only at 9%. So the entire dream of the investor to generate 10% return for the next 14 years fall apart. Why does it fall apart? Because when the market rates are lower, investors doesn't want the borrower to pay the money back. Guys, just give me 1 second. Again, I'll repeat. If the investor was thinking that I should get 10% return for the next 14 years, that dream fell apart because when the market rates go lower to 9%, the investor wants the borrower to keep the money back. Because if the investor gets the money from the borrower, the investor will be able to reinvest that money only at 9%. But what is the assumption? That he'll get 10% return. Is he getting 10% return? The answer is no. So on some money, he will get 10% return for the 11 years. But for the remaining 3 years, he will be able to get only 9% return on that much money. Versus his initial assumption that he will get 10% return for all the 14 years. Take another scenario, the market rate goes up to 12%. If the market rate goes up to 12%, investors will be very happy if some people repay the money faster. But look at from the homeowner's perspective. I've taken a loan at 10%. If I take a loan today, I'll pay 12%. Am I in any hurry to pay the loan back? No. And in this case, I'll delay the loan. But guys, I'm not going to default. I'm not going to take more than 20 years, because if I take more than 20 years, I'm going to default and there'll be penalties. But you know what I'm going to do? I'll make the payment in 17 years. Did I default? No. It's just that I slowed down the payments. And as a result, compared to the expectation of the investor that I'll repay the money in 14 years, I'm repaying the money in 17 years. This is again bad for the investors. Investors thought that they'll get the money back in the next 14 years and they'll be able to reinvest money into the market at a higher market rate. But I'm delaying that process. So this part is what we call as is the prepayment risk. Sorry, is a contraction risk. Contraction risk means that as a borrower, I have an option to pay back faster. So rather than 14 years, I'll take 11 years to repay the home loan. And this is a risk for the investors because they will not be able to reinvest the money at the same rate of return. This is what we call as extension risk. In this case, I'm prepaying slower than estimated. As a result, rather than 14 years, I'm taking 17 years. So the investor will have to wait for another 3 years to get the money back and reinvest the money at a higher market rate of 12%. So contraction risk is prepayment being faster than estimated. And the extension risk is prepayment being slower than estimated. And the combination of a contraction risk and the extension risk is what we call as the prepayment risk. The prepayment is an option with the borrower, and as a result is a risk for the investor. That I'll prepay faster when the market rates are lower. And I'll prepay slower when the market rates are higher. And both of them are bad for the investors. Very important concept. Ask me questions, but you should be very thorough. So we will say that the prepayment risk can be divided into two components. One is contraction risk, the other one is the extension risk. Cool. So read with me here, guys. Prepayments are principal repayments by mortgage borrower in excess of the scheduled principal repayment. The risk that prepayment will be slower than estimated is called the extension risk, and the prepayment will be faster than estimated is called the contraction risk. One mistake what many people do is that they believe that when the prepayments are slower than anticipated, the people are defaulting on the loan. No, they will take longer than 14 years, but they won't take longer than 20 years. Okay, that's a very important part. So extension risk means पहले लोगों को लग रहा था कि they will prepay at this pace, but they're prepaying at a slower pace. So rather than 14 years, they're taking 17 years. But still it's within 20 years. So the investors have a risk because they will receive the cash flow sooner than expected in a low rate environment. When the market rates are lower at 9%, they will get the money back faster. If they get the money back faster, are they able to reinvest at 10%? No, they are getting only 9% on that money. And when the interest rates are higher, they want the money back faster so that they can reinvest money at 12%. But in that case, they're getting the money slower than estimated. So both of them is a risk for the investors. I already discussed about the residential and the commercial MBS. In case of a residential mortgage, the investor has a risk, right? Why there's a risk? Because the homeowner will repay it when the market rates are lower and will delay the payments when the market rates are higher. Investors will say, Arey yaar, had I lose, tails you win. I don't win in any case because you decide when to make the payments. So as a result, the investor can say that there will be a prepayment penalties. What is a prepayment penalty? That if you make a prepayment, I'm not stopping you not to make a prepayment, but you'll have to pay some fees such that the loss which I'm incurring, I can compensate for that loss. These loans can be recourse loans or the non-recourse loans. What are recourse loans? Or say, let's start with non-recourse loans. Let's say I take a loan on my property, which I'm buying. The property is worth 1 crore rupees. I've taken a loan worth 90 lakh rupees. If I'm not able to repay the loan, the bank can take this particular property on which I've taken a loan, sell it in the market, and try to get their money back. If for some reason the value of this property is not enough, or the bank is not able to sell it at a particular price, and they don't get their full money back, even if I've got another 10 properties with me, the bank cannot touch those properties. Even if I've got like a few kilograms of gold with me, the bank cannot touch that. This is what we call as non-recourse loan. But if it's a recourse loan, if they cannot get their money back from this property, they will come after all the other properties, all the other assets, all the other bank accounts I have to get their money back. So what is safer for the investors? The recourse loan or the non-recourse loan? Non-recourse. Which one is safer, recourse or non-recourse? Recourse loan. Recourse loan is always better because technically all my personal properties is a collateral for you. Now there are two things, loan to value ratio and debt to income ratio. What do we mean by that? Let's say if I'm planning to buy a property worth 1 crore rupees, okay? How much loan can I take if the property value is 1 crore rupees? That's the question. So in this case, the loan amount depends on two factors. One is the property value. Generally, in case of India, it will be like, okay, the loan amount cannot be more than 80% of the property value. Some private banks are aggressive, they give 90%. And some of the new banks, like, the startup banks, they're even more aggressive, they give up to 95%. But generally, like a typical large bank like HDFC Bank and SBI Bank, they will give up to 85% of the loan amount in the form of a loan. So the loan, you can, give me 1 second. Sorry, guys. So in this case, if I can take up to 85% of the amount in the form of loan, the total loan amount I can take is equal to 85 lakh rupees.
And can you please repeat once? I just got lost.
Okay. So I'm saying that if the property I'm buying is worth 1 crore rupees, the question is how much loan can I take? The loan amount depends on two things. One is how much loan can I take as a percentage of the property value? So this is what we call as loan to value ratio. In case of India, generally the loan to value ratio could be around 85%. So the total loan amount you can take is worth 85 lakh rupees. That's one consideration. But will you always get a loan worth 85 lakh rupees? If that is the scenario, guys, I wanted to buy a property worth like this, a property in Nariman Point in Bombay is a commercial property which is worth 950 crore rupees. Let's assume 1,000 crore rupees, including the registration fees and everything. Going by 85% of it, the total loan I should be able to take is 850 crore rupees. Do you think I'll be able to take this loan? No. The problem here is not the loan to value ratio. The other important thing is debt to income ratio. So let's say the bank will say, okay, what is your annual income? If I say that my annual income is 25 lakh rupees, they will say that, okay, debt to income ratio can be 3 times. It means if your annual income is 25 lakh rupees, we will pay you a total loan amount of 25 lakhs into 3, which is 75 lakh rupees. So in this case, if the property is worth 1 crore rupees, going by the loan to value ratio, I can get a loan worth 85 lakh rupees. But given the debt to income ratio, given my income is 25 lakh rupees, I'll get a loan worth only 75 lakh rupees. So in this case, between 75 and 85, whichever is lower is the loan I'll get from the bank. Given 75 lakh rupees is lower than 85 lakh rupees, the bank will give me a loan worth 75 lakh rupees. Yahan pe, yes, I can buy this 1,000 crore rupees ka thing. Going by loan to value ratio, can I take a loan worth 850 crore rupees? Yes. But think about my income is worth 1 crore rupees. And going by 3 times the ratio, the maximum loan I can take is 3 crore rupees only. So the bank will take the lower of these two and say, okay, you want to buy a property worth 1,000 crore rupees? Yes, buy it. But they will give you a loan of only 3 crore rupees. Okay? So we'll take the lower of loan to value ratio and the debt to income ratio. As per loan to value ratio, the loan I can take is 85. As per debt to income ratio, I can take a total loan worth 75. So I'll take the lower of these two, which is worth 75. Okay? So they've done all this calculation. The residential mortgage-backed security can be through an agency or a non-agency. What is an agency? This is from the government sponsored enterprise. Which are the government sponsored enterprise? They've not mentioned it here, but this generally includes Freddie Mac and Fannie Mae. These are the two government sponsored agencies in case of the United States. They are like, kind of, I won't call it a public bank, but these are the banks which will make sure that, everything is done in a very, very safe manner. And if these banks are ready to give a loan, means the chances of the subprime mortgage or the chance of defaults are very, very less. Non-agency mortgage means all the other commercial banks are doing it. They can take some risk. They can do something crazy. They can be aggressive. So that's the reason we call it non-agency RMBS. See, 2007, 2009. So when you talk about agency RMBS, there's no scope of 2007, 2009. But when you talk about non-agency RMBS, there could be a risk that banks go a bit crazy. And as a result, they can get into a financial crisis. Most of the securities are pass-through securities, like whatever, pass-through in the sense that the cash flow, what the homeowner pays to the bank, the HDFC Bank will give it to the investment bank, and the investment bank will give it to the investors. So this is how the structure works. All the homeowners will pay the EMI. That pool of EMI, the HDFC Bank will give it to the investment bank, and the investment bank will give it to the investors. So we call it pass-through security. इसके अंदर भी weighted average maturity निकाल सकते हो. Different homeowners may have a different maturity. So you can calculate a weighted average maturity. Different people might be paying different coupon rate or different interest rate. You can calculate a weighted average coupon rate. ठीक है? So when you make a security out of the collateralized mortgage obligation, so a CDO is a normal term. तुम CDO को multiple parts में divide करते हो, it becomes a CDO. But जो debt है, if it's a mortgage debt, we call it CMO. So ABS is an asset-backed security. If the underlying security is mortgage, it's called MBS. So ABS is an umbrella. MBS is a part of that umbrella. वैसे ही CDO is an umbrella. CMO is a part of that umbrella. क्योंकि जो debt है, that's a mortgage debt. So CDO and CMO for me practically the same thing. This is a collateralized mortgage obligation or the tranches which has been created from the pool of mortgages. Now this can be done using multiple things. So guys, this thing becomes very, very important when you get into level 2. There's a whole chapter into it, but it's just like being touched upon in your level 1. So इसमें क्या होता है, and I think that this is like coming from the question Rakesh asked, कि how the money will be distributed to the investors. So in this case, some investor will say, okay, we want to invest into principal only tranche. इसका मतलब क्या होगा कि जो भी homeowner से पैसा आ रहा है, जो principal वाला पैसा आ रहा है, that will go to those investors. They won't get any interest, they'll get only the principal part of it. Other investors who are interest only tranche, interest only securities, they will get all the interest payment from the homeowners. Now let me explain you a bit more what's happening here. सबका पहले assumption है कि 14 years is what the homeowners will take to repay the home loan. And if you try to do the calculation as per this, तुम्हें लग रहा है if they take 14 years to repay the home loan, the total principal will be same. Principal amount तो कोई same ही रहेगा, right? Assuming they're not going to default, the principal amount will be equal to 1,000 crore rupees. And the interest part on this 1,000 crore rupees, because the money will be paid in 14 years, will be close to 500 crore rupees. That is your initial assumption. ठीक है? Let's say if rather than 14 years, these people take 17 years to repay the home loan. The total amount you'll get from the principal is only 1,000 crore rupees. What do you think will happen to the interest part? Will it be 500, more than 500, or less than 500?
More than 5 because longer duration.
They're taking longer. So let's assume this will be 600 crore rupees. And let's say if the payment happens within 11 years, Principal तो same ही रहेगा 1000 crore rupees. What will be the interest?
Yes.
Let's assume 420 crore rupees. So this is the base assumption. अभी अगर मुझे लग रहा है कि people will take longer than 14 years to repay the home loan, I will buy an interest only tranche. So in this case, what will happen is this 1000 crore rupees, today I'll pay only 700 crore rupees to buy this. And for this 420 crore rupees, I'll pay only 300 crore rupees to buy this. Total, the investment bank is getting is 1000 crore rupees. But if I think that people are going to take longer to repay the home loan, I will buy this particular tranche for 300 crore rupees, because rather than 14 years, it will take 17 years. But the amount of money I'm getting is quite significantly more. But if I think that people will pay faster, I'll buy this tranche. I'm getting the same amount of money, but within 11 years rather than 14 years. तो ऐसा नहीं है कि इंटरेस्ट वाले को पूरा इंटरेस्ट मिल जाएगा, प्रिंसिपल वाले को कुछ रिटर्न ही नहीं मिलेगा. It's kind of a zero coupon bond, or whatever you call it. But in this case, technical thing is, if you see an extension risk, this is the extension risk, right? In case of an extension risk, interest tranche will do better. But if it's a contraction risk, the principal tranche do better, though the money you'll receive is same in case of principal tranche, but you'll get it much sooner than estimated. Okay, this is one way you can classify those heaps. Interest only versus principal only. एक दूसरा तरीका होता है based on the riskiness. Safer ऊपर आएगा और जो risky है वो नीचे आएगा. Whenever there's a risky tranche, we call it Z tranche. So in this case, the Z tranche have the highest risk in case of a default. क्योंकि जो बचा खुचा है वो Z tranche के पास जाएगा. So Z tranche, also called as accrual or accretion branch, is a CMO tranche that receives no interest payment during a specified accrual period. Okay, I think I can go into more detail. So Z tranche के अंदर क्या होता है, guys? I'll give you an example. कि let's say the company, the total money, watch the safe tranche, let's call it A tranche, which is a safe tranche. This is Z tranche. Okay. And the total money I'm going to receive is, let's say, 50 crore rupees. So what I'm thinking is that from that 50 crore rupees, I'll pay some money in the form of principal and interest to A tranche, and I'll save some principal and interest to Z tranche. This is my expectation. If I get 50 crore rupees, I'll pay 30 crore rupees here and 5 crore rupees here. I'll pay 12 here and 3 here. So the total money I'll repay out is 50 crore rupees. Next month, my expectation is I'll get 70 crore rupees because more and more people will prepay. So from that 70 crore rupees, I'll pay 40 and 6, and I'll pay 11 and 3. That is my expectation. Is it equals to 70? Yeah. Sorry, 60 हुआ ये तो. So 45, 7, 13 and 4. अभी भी 17 नहीं हुआ. So 15, 16 and 2. So guys, interest will keep coming down actually. So I should consider that as well. Why? Because if I repay some money, the interest component will be lower. So this is equal to 70. And third year, my expectation is that I'll get 80 crore rupees. And how I'm going to divide that 80 crore rupees? I'll pay 60 here. The interest will be just small. I'll pay more money here, but the interest will be small. Is equal to 80 crore rupees? No, it's more than 80 crore rupees. So this is 60. So this is how I'm planning to divide the money into these people. If it was tranche A and tranche B. But what I'm trying to do is I want to make tranche A to be a safer tranche. What do I mean by safer tranche? A safer tranche is something which doesn't have a default risk, which doesn't have a prepayment risk as well. What is the prepayment risk? Is a combination of extension risk and the contraction risk. So what I'm going to do is I'll tell Z tranche that, dude, if the money which I receive is more than 50 crore rupees, let's say is equal to 40 crore rupees, you won't get your full money back. So compared to the estimate, rather than 50 crore rupees, I'm getting only 40 crore rupees. So the A tranche still got their principal, A tranche still got their interest, but the entire 10 crore rupees, I'm not paying money to the Z tranche. So there was an extension risk that the borrowers are taking longer than estimated to pay the money back. But did tranche A suffer the risk? No, the entire risk is being transferred to the Z tranche. Let's say the next month, rather than 70 crore rupees, you get a payment of 75 crore rupees. There's an extra 5 crore rupees. Doesn't matter. A tranche will get what is being told to them. All the extra payment will go to the Z tranche. So what you're doing is you're using the Z tranche to dump all the additional money or not to give them the money if you do not receive enough money. So they feel all the pressure. And that's the reason this tranche has the highest prepayment risk. Because if the people don't pay, these are the people who won't receive money. If people pay faster, these are the people who will get the entire higher repayments. Now, in this case, there's a possibility that these Z tranche people, you don't want to pay them any principal back. Why you don't want to pay them any principal back? Because in case there's a default going forward, you want to dump all the default on these people as well. As a result, on these tranches, you just pay them the interest and you do not pay them any principal. So as a result, if the total money being invested by A tranche is equal to 900 crore rupees, and the total money being invested by Z tranche is 100 crore rupees, up to the default of 100 crore rupees, A tranche is safe, because up to 100 crore rupees, all the losses will be borne by Z tranche. So they will start receiving money only after all the 900 crore rupees with interest has been paid to the tranche A. So that's the reason this tranche is also called as a zero coupon tranche, where they do not receive any coupon payments, they do not receive any annual payments, and they receive the lump sum payment only after all the 900 crore rupees has been paid to tranche A. So guys, tranche Z is very, very risky. As a result, they'll get a 10% return maybe. Tranche A is very, very safe. They'll get a return of only 4% maybe. Guys, read with me. In case of a Z tranche is a CMO tranche that receives no interest payment during a specified accrual period. So in some cases, they don't even get the interest payment. Forget about the principal. Instead, during the accrual period, the tranche accrues interest. It keeps getting added, and they get the payment only towards the end of it. Once the accrual payment has ended, interest and principal payments on the Z tranche begin. So in this case, what they're saying is they won't even get this 3, 2, and 1. This will keep getting accumulated, and they'll get the payment towards the end of the tenure. So no principal, no interest. All the payments will go to A tranche, and after something is left, that will be given to the Z tranche. Principal only we talked about, interest only we talked about. Sometimes there can be a floating rate tranche where the interest rate will change with the change in the market rate. The residual tranche, only after the payment has been made to all the other tranches, only then you'll make the payment. So this is not very different from the Z tranche. And guys, this is what I was talking about. Planned amortization class. You'll have more fun with it once you get into level 2. So in this case, what you're telling is you are using this Z tranche not as a residual tranche, but you're using it as support tranche. In this case, if the payments are more, you'll make the payments to this tranche. If the payments are less, you will not make the payments to this tranche. So all the prepayment risk is being transferred to the tranche B. So guys, you can use this tranche B as a residual tranche, then we call it the Z tranche, or you can use this tranche to pass on all the prepayment risk. Then we call it a support tranche. Okay. So in this case, this tranche A becomes a planned amortization class, in the sense that if you've committed these people that they'll get only this much principal at the end of every year, they'll get only this much principal. Because if the prepayments are more, those prepayments will go to the tranche B. If the prepayments are lower, the tranche B will not get the enough principal. But this tranche A, will be safer. They will not suffer the risk if the prepayments are more or the prepayments are less. So they'll always get 30, 48, and 60 for the next 3 years. There's a possibility that if the prepayments are not 50, if the prepayments are only 25. So even if you do not make any payment to these people, still do you have 35 crore rupees? No. Then you'll have to cut down the principal to these people as well. But that's a very, very extreme scenario. Or let's say the prepayments are very much. Instead of 80, you got 150. If you got 150, you don't want to pay the entire extra 70 crore rupees to these people, because you'll end up paying the full principal to these people. And what if there's a default going forward? So if the prepayments are in a particular range, the entire risk will be transferred to the tranche B. And in that range, tranche A will not suffer any prepayment risk, because all the extra payments will go to tranche B. If there are no payments, tranche B will not receive the payments. So in this case, tranche A is called the planned amortization class, and the tranche B is called the support tranche. A planned amortization class is a structure to make predictable payments to the investors as long as prepayment spends remain within a certain range. कि उस range के बाहर चला गया तो support tranche will not be able to support. So in this way, both the contraction risk and the extension risk are reduced for the planned amortization class. कि जो extra payment आएगा वो tranche B के पास चला जाएगा. अगर extra payment नहीं आ रहा है तो tranche B को payment नहीं मिलेगा. This kind of a cushion for you. This protection is limited by the range of prepayment speed. अगर prepayment speed बहुत ज़्यादा है तो that support tranche will not be able to support. Now prepayment speed बहुत कम है तो again the support tranche will not be able to support. Yeah, please ask me.
So for the jet tranche and PO, IO or floating tranche, so prepayment, is there any impact of the prepayment on all 5 tranches, sir?
नहीं तो see, you have to do it separately. तो कैसे करना होगा? One combination could be principal only tranche. अगर एक principal only tranche है तो दूसरा tranche होगा interest only tranche. So don't mix things. So this could be one combination number 1. This is a combo 1. Combo 2 क्या है? कि there will be a main tranche and there will be a Z tranche. क्योंकि इसको सब पैसा मिलेगा, इसको पैसा मिलने के बाद Z tranche के पास पैसा जाएगा. Combo 3 क्या है? कि this will be the PAC tranche, planned amortization class tranche. So the another tranche will be what we call as support tranche. So either you can divide the tranches into principal versus interest, you can divide the tranches into main tranche versus Z tranche, or you can divide the tranches into planned amortization class versus support tranche. So I don't see a possibility of interest only tranche and a Z tranche in the same case. So guys, it's just not like knowing what exactly it is, but understanding the logic of it. Now, you tell me, why will somebody invest into the support tranche? अगर मुझे लग रहा है कि prepayment risk will be exactly equal to 14 years, sorry, the prepayment will happen in 14 years. There's a very less chance of a extension risk. There's a very less chance of a contraction risk. I will invest into support tranche because then I'm getting a higher return, but I'm not taking higher risk. Why will somebody invest into planned amortization class? Though I'm getting a very lower return, but I see a very high risk of an extension risk or a contraction risk. So I think that even if I'm getting a lower return, still it's justified, given that the risk is going to be a lot higher than what people estimate. If I see that the main tranche here will get a very low return, but if I see that the possibility of a bad debt is very high, I'll invest into main tranche. But if I see that the possibility of a bad debt is very less, I'll invest into a Z tranche. So guys, it's always versus what others estimate. What others estimate is the consensus, and this is the price you will pay. If you have a different estimate than that, you will buy that particular thing. So I'll give an example. Let's say people believe that there's a 2% bad debt chance. This is what the market believes. अगर तुम्हें लग रहा है कि bad debt will be more than 2%, buy the main tranche. अगर तुम्हें लग रहा है less than 2% bad debt होगा, buy the Z tranche. Simple. So compared to the market, what's your expectation is? ठीक है? Now shifting to the commercial MBS, the only thing is the property which you're buying is a commercial property. Everything else remains the same. An important difference between residential and commercial MBS is the obligation of the borrower of the underlying loans. In case of residential, MBS loans are repaid by the owners or the occupiers of the property. So if I take a home loan, I am responsible from my income to pay the loan back. Because property is not earning anything, right? The property is being used for the residential purpose. But in case of a commercial property, commercial MBS loans are repaid by the real estate investors, who in turn rely on tenants or businesses. So in that case, I'm looking at the property usage and the owner of the property or the purpose of the property. Let's say if the property is being used by tenants, so the rental from those tenants will be used to repay the loan. So in case of residential MBS, the focus is on who the borrower is. In case of commercial MBS, the purpose is for which purpose the property is being used for. Guys, we already talked about loan to value ratio and the debt service coverage ratio, that how much loan you can take as a percentage of total loan amount. In all these things we discussed, the borrower has an option to repay the money back. So it's kind of a callable bond. So the investor wants a protection from the callable bond. And this is what we call as call protection. Investors are concerned that the borrower will repay the money when the market rates are lower and will extend the payment when the market rates are higher. Either case, investors are going to lose money and they want a protection against it. So that protection is what we call as call protection. What can they do as an investor? They will say there's a prepayment lockout. Hey, you can make a prepayment, but you cannot do any prepayment for the next 3 years. चलो यार 3 साल के लिए तो कम से कम we are safe. So I'm not saying you cannot make a prepayment, but you cannot make a prepayment for the first 3 years. Prepayment penalty, I already talked to you about. I'm not saying that you cannot make a prepayment after 3 years, but there will be a penalty for it. There's something called deficiency. So in this case, the main point here is that if the borrower uses payments in excess of the schedule. So let's say the EMI was 1 lakh rupees, but I make a payment in excess of 1 lakh rupees. As an investor, I'll keep that extra money I got from you in a government security. But when are you going to pay me extra? When the market rates are lower. Rather than 10%, the market rates are 9%. I'll go and put that money in a government security paying me 9%. Am I getting 10%? No, there's a 1% का shortfall. Who will pay that shortfall? The borrower will pay the shortfall. अब तुम बोलोगे फायदा ही क्या है बोरोवर को इससे, क्योंकि रीपे भी कर रहे हो और तुम्हें 10% देना भी पड़ रहा है. So इसके अंदर the main benefit is that you can get your papers back, because once you repay the loan, you do not have to keep your property collateral anymore. But technically, as an investor, I'm not losing, because whatever is the shortfall, I'm taking it from you. Now, the loans can be fully amortized or partially amortized. I think we discussed about it. Fully amortized means in the form of EMI. By the time I pay the last EMI, there's no lump sum payment required. Right? So it means that I repay the loan in a very, very smooth way every month, and there's no balloon payment, there's no lump sum payment at the time of maturity. This is what we call as fully amortized loan. Another extreme would be every month I just pay the interest, and at the time of maturity at the end of 20 years, I pay the full 1 crore rupees. It's called bullet loan. Like I'm repaying the entire amount in a single bullet. But in between these two extremes, there's something called partially amortized loan. I pay every month some amount of interest and some amount of principal in such a way that by the time of maturity, out of 1 crore rupees, I've already paid 60 lakh rupees. And the remaining 40 lakh rupees, I'll make as a lump sum payment. And this 40 lakh rupees is what we call as a balloon payment. It's a lump sum payment in a partially amortized loan. So there's a risk called balloon risk. What if the borrower is not able to make that lump sum payment at the time of maturity? See guys, it's easier to pay 30,000 rupees every month, but it may not be that easy to make a payment of 30 lakh rupees in a lump sum after 20 years. So bigger the balloon payment, bigger is the balloon risk. Okay? So that's broadly about it. I'll stop here for a few seconds. Let me know. Guys, any questions, any comments?
what will be the next topic we'll be covering in our upcoming classes?
I have no idea. Sorry, I'll come to know on Monday.
Sure.
Which all topics are left, by the way? Economics is left, I think.
Economics.
In derivatives. Yeah.
Okay, so if you have any preference per se, let me know and I'll try to get that topic, but I cannot guarantee anything. That's all we can try. So maybe put your preference in the chat window. We'll take the majority. I'll try to push for that particular topic next.
I think portfolio management also is not completed.
Okay. FSA is also pending.
No, sir. FSA is completed. FSA, corporate issues, equity.
FSA is there are two different batches.
Okay, there are two different batches altogether. Okay, which is a common topic which is left in both the batches, I think will be taken next.
I think portfolio management.
Okay, so equity and FSA is done, right? For at least some of you, if not all of you.
Yes, sir.
Okay.
So eco and
Portfolio
derivative
management and portfolio management.
Yes, yes. These are
So
the common.
within these three topics, which are common and left for all both the
Yes.
batches, which one you want to be done first? Put a
Eco, sir.
choice. Put a choice in the chat window. I'll take a majority and I'll try to push for it. I do not guarantee anything. Let's try. Okay, I think it's about economics, majority of it. So I'll try to push for it. Let's see. Okay. If not economics, then it's portfolio. But there's only a single vote for derivatives. Okay, let's try what we can do. Any questions otherwise, guys? Anything you want me to repeat within fixed income? Anything which doesn't?
Sir, is that possible? Can we collect all the things? I mean, like upward, whatever covered under the fixed income. So there are so many. What can I say? So let's say, sir, there is upward movement and downward movement and flat curve, whatever it may be, interest rates parameters are there. Can we put into only one collect that all things into one? Is it possible in the remaining times?
Like in real world, you mean? I didn't follow your question, to be honest. Matlab, collate everything into one what?
Just a second, sir. Let me recall.
No worries. In the meantime, guys, anyone, any other question? General question about your exams.
Sorry, where we can solve our doubts or ask our doubts.
See, I can give you my email ID, but again, like Monday to Friday is very hectic for me at times. So the best, like if you got like small doubts, I can always clarify on mail and we can connect offline on Zoom call or on phone call. But if it's something which is going to take you long, then I would suggest, like be in touch with the coordinator. They'll put you in touch with one of the faculties and, they will sort out all the doubts for you.
Ansh, one question on that LMS. Is it necessary that we should complete all the topics given in the LMS and complete? I mean, achieve that 100% completion status?
Okay, so there's nothing called 100%. First of all, If you want to do 100%, read it from curriculum books. Swayze will never give you 100%. Okay?
No, not that. The same thing only. I think there is a course completion progress or something which they mention as in percentage terms, something like that. So is that a prerequisite that we should complete, or I mean, some completion status is actually in LMS so that we are eligible to sit in the exam, something like that?
Oh, for the CFA institute, you're saying?
Yep.
No. So there's no prerequisite for that. I thought like your question is coming about like, should you complete 100% of your syllabus, or you should complete 90-95% of your syllabus, but do it properly. So nobody like possible, right? You're not using LMS to study. You're using some offline tool to study. So that's not a criteria at all, for you to be able to write exams or not.
All right.
Correct me if anybody has a different opinion on that, but I didn't know like, they track your LMS. It's just for your own purpose. It's not for them to track.
All right. Any other prerequisite? I think for it, I mean, we should be bringing the passport or something.
Yes, passport is a very important prerequisite. Make sure that you have a passport with an expiry not within 6 months when you go for the examination.
All right.
Riya, you were trying to say something?
Yeah. I was saying for FSA, do we have something which gives a difference between GAP and IFRS for each and everything? Because it's too lengthy. So do we have any reading material where all the differences are listed out together?
Do I have it? Like one of the students sent what he had compiled.
Yeah.
I can share it with you, but a lot has changed. Like I have it like from 3 years back.
Okay.
And there have been some changes, not in terms of in terms of GAP versus IFRS, but what is covered in your syllabus. So the list is longer than what you need it for, and it'll just increase the complication rather than solving it. So I would say that, yeah, sorry, go ahead.
Yeah, so it means that only the additions would be there in the existing difference list, no changes as of which was already there, right?
Yeah, the list is a lot longer because they've curtailed the FSA in the recent years.
Yeah, okay. But then please share that, at least some idea I will get and I can work on my own list.
Actually,
Sure.
The
five
second
KPIs also that discusses the differences. You can check online also.
Sorry, Sobek? I didn't.
There is a like document from KPMG also that discusses the differences between IFRS and US GAAP. So you can check that online also.
Oh, wait a minute. Nice idea, but the problem is that is it specific to CFA syllabus?
Maybe not, but it is little bit expensive, but you can have a look at it.
Yeah, so that's the thing I'm concerned about. Like there are lots of documents and there are like 1,000 such differences. Do you want to look at a longer list? The answer is no. If your purpose is to prepare for the exams only, then all you care about is like 30-40 key differences, which are relevant for your CFA level 1 only. So that specific list, I think like I have seen that list from Fintree or somewhere. I have to look up again. If they have an updated list only for CFA level 1, there'll be the more specific and relevant list for you. But nothing better than making your own list.
Yeah.
Always a better choice. But I'll try to look up for it.
One more question, Ansh. So I'm appearing for November exam. I wanted to understand like for what all topics I should like compulsorily do from the curriculum. Not sure, sir.
Ethics.
Yeah.
And any other topic which gives you a nightmare. तो जैसे होता है ना कि अरे यार economics I don't like, do it from curriculum.
Okay.
Yeah, अरे I'm not an accounting student, FSA is something I'm not comfortable with, do it from curriculum. But I won't suggest doing more than 15 to 20% from curriculum unless you're ready to spend 1,000 hours for the preparation. And derivatives is one thing I would suggest. You can see, again, depends like how many hours you're going to spend. The ideal thing is you do everything from curriculum and spend 1,000 hours. But the bare minimum is ethics. The second important thing is something you're not comfortable with. And the third topic I would suggest is derivatives. Because derivatives is a bit more complicated unless you've done it in your college or your other MBA programs. So even the finance students find derivatives a bit difficult.
Thank you.
Any other question? Oh, let me roll out the feedback form.
Sir, what will be the ratio of theoretical versus calculate practical questions, sir?
Okay. What do you call as a practical question? Like something requires calculator? Is that a
Yes,
practical
sir.
question?
Calculations wala formula plug and check.
Acha. So I keep making a statement that if somebody gives me enough money and challenges me to go for level 1 exams without a calculator, I think I'll be able to pass the exam. Not that I'm very good at calculation, but it's just that many questions which sounds like a calculator based question is not a calculator based question. We did lots of this work in fixed income class, right? अरे
Yes,
calculation lag raha hai pura, but it's not a calculation based question. It's just asking whether the bond will be trading at a premium or a discount.
yes, sir, correct.
So going by the look of it, I would say like 50% is theory, 50% is practical. But within 50% practical, at least half of them doesn't require a calculator. They're like more of conceptual or simple calculations. So maybe like out of 180 questions, there'll be just 20 or 30 questions which actually requires a calculator.
You mean to say that 80-20 will be ratio? 80 will be
No,
theoretical.
नहीं मतलब वही practical रहेंगे, numbers रहेंगे उसके अंदर, but
Okay.
with some
So
approximation, with some logic, you can still
logic.
solve those questions without calculator. But level 2 में जाओगे तो there'll be at least 30-40 such question कि you need an extensive calculator to solve those questions.
और
Ansh,
क्वेश्चंस कैसे प्लेन रहेंगे या फिर बहुत कॉन्सेप्चुअल या फिर राउंड अप रहेंगे सर? आई मीन हाउ दैट
Okay,
विल बी
so
पैटर्न?
straight questions, forget about it. नहीं आते straight questions. They'll put
Okay.
lots of meat around it. मतलब कहानी बनाते रहेंगे उसके पीछे, कॉन्टेक्स्ट बनाते रहेंगे उसके पीछे, राइट? स्पेशली इन एथिक्स पूछना उनको सिंपल सा ही है कि वो मटेरियल गिफ्ट ले सकते हैं नहीं ले सकते हैं, उसके पीछे पूरा स्टोरी बनाएंगे कि ये कंपनी है, वो ये काम करती है, ये इन्वेस्टर है, वो ये कर रहा है, ब्ला 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 ब्ला. सो दे बीट अ लॉट अराउंड द बश. दे गिव यू लॉट्स ऑफ डेटा. तो तुम्हें 10 डेटा पॉइंट दे देंगे, पता चला आंसर के लिए खाली तुम्हें 2 ही डेटा पॉइंट चाहिए. But they want to see your clarity कि how you can pick what you need without getting worried. जैसे मेरे को याद है 10th के अंदर मैं एग्जाम लिख रहा था अकाउंट्स का. If something is given in the question, उसका कहीं ना कुछ यूज तो होना ही है. But CFA में it's completely different. Just because it's given in the question does not mean कि you have to use it. They want to see the clarity with you कि do you understand that how this part is irrelevant for this particular question. So they beat around the bush a lot. They give you lots of additional information. And yeah, if unless you're clear with the concept, you'll not be able to answer many questions. So my focus is a lot more key. Do you make sense of it? Is it logical? Is it intuitive? Do you understand it? That's the most important part.
Ansh, I have one small question. Like, can we do these calculations regarding bond using calculator? Thing like the accrual interest and all those things.
Accrued interest.
Like I saw like there are few functions in the calculator mentioning bond, amortization, those things. So do we use those things or?
Ideally, you should, but उसका usage इतना कम है कि that can only be used only for one type of question. So yeah, like it's similar to Excel sheet, right? कितना भी Excel sheet use कर लो, do you know the entire Excel till today?
No.
वैसे ये calculator is so extensive कि do I know the entire calculator? No. So yes, there will be a way to calculate it, but it's not worth doing it.
Meanwhile, Savik, I will share one video of calculator which they have provided whole demo of the how to where to use accrued interest and वगैरह functions in of the calculator. So I will share in the group.
Yeah, please do that. So guys, I'm saying कि कुछ जो simply like you can do it using the calculator without using those function. क्योंकि function को याद रखना भी is a pain, right? And if you're not using that function very regularly, you'll forget that function. So that's my only suggestion to you. But if you think it's going to be used multiple times and it's easy to remember that function, nothing like it. क्योंकि calculator है तो use तो करो फिर उसको. So yeah, please share that video link in case anybody wants to see and pick a couple of additional functions they have not used so far.
3 to 4 hours video is there, so I will send that video in group.
Guys, feel free to log off. If you got any questions, please stay back. I'm here for another couple of minutes.
Ansh, I have a small query.
Yep.
So how many marks ideally one should be giving for this to hold?
Ideally, like a few, like 20, 30, 40. But again, like I would say that don't the time between the mocks you like 5 to 6 mocks are good enough. That should be the bare minimum so that you get an idea about how long does it take for you to complete the questions, for you to strategize that, key how you go about each and every question, the so that you know the difficulty level in the exams, for you to know कि difficult areas कौन से तुम्हारे strengths कौन से weaknesses कौन से हैं. So minimum 5 to 6 is I would say, and doing more than 10, 15 doesn't make any sense. If you have that much time, go and revisit some of the concepts, go and revisit some of the difficult topics and the difficult subjects which you're facing problem with. So
And
5
if
to 15 is the range.
okay. And
And
if
when I
I
say, sorry, let me just add one more thing. Like when I say mock paper, like a mock paper is just not like solving it for like 2.5 hours, but going and trying to understand what did you do wrong? What is the methodology you followed? Is there a better way of doing the same question? Did you get the question right because you know the question, or you got it right just by fluke? Making a list, like making a summary कि हर मॉक के अंदर तुम्हारा क्या क्या स्कोर आ रहा है, कितना अटेम्प्ट किया है, कितना सही है, कितना गलत है. Because when you do this exercise for the next 5, 6, 7 mocks, you'll get an easy output. कि अच्छा ethics के अंदर though I'm solving 100%, my accuracy is bad. इसके अंदर this is a very strong area I don't want to spend more time on. So all this data is very important, and you have to make sure that you keep track of this data, which will be very useful in the last couple of weeks when you'll be looking for कि कहाँ पे additional time spend करना चाहिए.
oh, and if I have to start from zero, so how would you suggest me from like you need to start with this subject and you should carry on that?
अगर start from zero, like I think I shared this with you before, but let me share it again.
Sorry, I missed your earlier lectures.
Okay. So this is something I always share in some of the initial classes. See, these are the topics. These are the three topics you can do it anytime during your preparation: ethics, economics, and alternative investment. You can do it the first, you can do it the last, because they are not dependent on anything, and nothing else is dependent on these three topics. These three topics should be done before you do these four topics. Because these four topics are directly dependent on these three topics. So you cannot do these four unless you do these three. So yes, you can pick any out of these six.
And we can do independent topics at the end also.
Yeah, but I would suggest ethics को last के लिए मत रखो. Ethics को पहले भी करो, बीच में भी करो, last में भी करो. Keep doing ethics throughout your preparation. क्योंकि it's a bit conceptual thing. It'll take some time to sink in. So if you just do it at the end, it won't sink in.
Got it. And please correct me if I'm what I'm doing of to do whole syllabus by syllabus and the questions and everything from curriculum. Is that the right?
हाँ मतलब but don't be religious ना कि ये मेरे को स्वेजर से ही करना है, ये मेरे को करिकुलम से ही करना है. You can mix and match, right? So equity, I always suggest do it from curriculum because it's such an important topic and it's a very small topic.
Equity and ethics from curriculum.
Yeah.
Other than that, everything can be
Not
done.
equity, ethics I'm saying.
Oh, okay. Ethics from curriculum, and other than that, everything can be done from syllabus.
You can, but the ideal thing is you do everything from curriculum. But that'll take lots of time. Do you have that much time is the question.
So yeah, so syllabus would be better.
Yeah.
Okay, thank you.
Cool.
Sir, actually, like not a doubt, but like I have a question for you.
Mhm.
Like the thing is, from next week, my college is starting, and like there are like some lectures scheduled on the weekend as well. So like
Okay.
my presence for the live class will be quite erratic. So
Okay.
like, is it fine with you? Like if I log out in the middle, or let's say join in the middle of the lecture, or should I like just stick with the recording?
Hmm. So see, like the reason you paid the money, I'll suggest like try to attend some of the live classes as well. But that being said, if you're not able to do it, like yes, you can feel free to join in middle. But वही है कि middle के अंदर, let's say if you already started on the topic and we are in middle of it, and you
Hmm.
try to catch up on that, तो इतना ज़्यादा easy नहीं रहेगा. So I would suggest like try to attend at the start of the class, or some you'll have to plan it. Or maybe like
Yeah.
let's say if I'm the faculty, like you can tell me, "Ki, sir, like tomorrow I plan to join around 12 rather than 9." So I'll tell you and I'll make sure that I do something so that when you come around 12, I'm starting with a new topic around that time. तो
Okay.
वैसा कुछ कर सकते हैं. तो like I can help you in terms of थोड़ा होता है ना planning के अंदर.
Hmm. Okay, sir. Like the thing was na कि not everyone likes this के dropping out in the middle of the lecture या फिर joining in the middle of the lecture. So that's why I was asking.
See, Varun, like for me, like I'll try to do whatever you can. You keep your video on. That means a lot to me, right?
Yeah, okay.
And it's a very genuine thing, right?
Yeah.
Not कि you're just like doing time pass and 2 घंटे के लिए आ गए and चले गए.
Hmm.
So and see, I won't, doesn't mean that I'll make others suffer because of it. कुछ केस में हो पाया तो कर
Absolutely.
लूंगा, नहीं हो पाया तो नहीं कर पाऊंगा फिर.
Hmm.
है
Okay,
ना?
sir. Yeah. Thank you.
Cool, man. Thank you. Bye bye.
Thank you. Bye.